I'm confused about the dollar in all of this, because part of that narrative about stocks moving higher and helping the monetary policy, well, it all has to do with financial conditions, but the dollar is such a big piece of that equation, not just for the Federal Reserve, but also for the BOJ, for the ECB, for the BOE, and for, I'm going to name two more, S&P and Norges Bank, all of the central banks is my point. And yet we're seeing no volatility at all.
A lot of rate decisions, and the other side of some of those FX trades will be in focus today then, Chrissy. We are open across European equity markets then, so let's keep an eye on what we get from a number of the corporates that Joe was taking us through. He referenced a few that could be on the move. Broadly speaking, though, the trend is just going to be stronger. The catch-up trade, post the Fed, we are going to see some moves to the upside. So we're up by 0.5% at the start of trade. Stock 600 up by that kind of amount. The FTSE 100 up by 0.7%. The DAX actually opens on time and up by 0.3%. The IBEX pretty strong. So that broad catch-up trade seems to be in place this morning.
ASML's up by 4%. That's a big move. The luxury companies are coming back. The miners are up as well, which I think is interesting. Svenska Handelsbank is getting absolutely battered. It's down by 11%, nearly 11% this morning. Novo's a little soft as well. So it does seem to be chips. Technology's doing well, unsurprisingly. It's interesting that the miners are bouncing back as well. I haven't seen any notes on miners. Maybe Joe will update us on that a little bit later. But you do have Rio, Glencore, all doing well today in trade. But technology looks like the real story. So SAP's strong as well.
Healthcare on the back foot, though. If you look at some of the worst or the bigger weights on the stock 600 and even the FTSE as well, you're seeing likes of GSK, you're seeing likes of Novo Nordisk take a little bit of a backseat. But to me, that feels a little bit more technical, because those were the outperformers in the last
it's honestly,
sessions.
One day on, one day off, isn't it? So a kind of, you're seeing this. Do I want to be in tech and luxury, or do I want to be in healthcare? And that seems to be the split at the moment in this market. One day on, one day off.
This is just a reflection of the rates conversation from yesterday. And a reference to your balloon. You know, these are the sectors that were being kept underwater as a result of nervousness about whether we'd get some counter pivot to the pivot from Jerome Powell. And we didn't get that. We didn't get a Fed that was excessively worried about the way that inflation is, has been coming back over the last couple of, or surprising to the upside over the last couple of months.
I think that's a weird kind of alliance, though, or a weird sympathy trait, because traditionally, at least from the way I view it, tech, big tech, ASML, SAP, should be trading in line with the pharma and the biotech. That is a defensive trade to me. The fact that they keep kind of switching off is
Are they rate sensitive? That's maybe a factor.
Is healthcare rate sensitive?
No, but tech could be. You could argue that maybe tech is more so. But the story coming out of yesterday is this is a US economy that is thriving. And it's going to continue to thrive. They're not worried about what's happening with the jobs data. They're willing to tolerate higher inflation for longer. The US economy, they want to see growth in that economy. Powell is terrified of any negative economic surprises, it seems. And that's great for stocks. That's great for consumer stocks. Maybe that's why LVMH, et cetera, is bouncing back. I appreciate they got battered yesterday.
Yeah, absolutely. So there's that sort of dynamic there. Thinking about mining stocks, you're saying, Guy, that's one of the best performing. It's the second best performing sector this morning. We've got iron ore up today. We're back over 100. Back over 100 there. It got down to 100, the iron ore price, and then sort of bounced off that level and has been bouncing for the last few days, for the last week or so. So interesting to continue to watch that sector and see where the direction of travel is. The auto sector very much in focus for us today.
Absolutely. So we'll see what BMW is doing. Just back to the chip story, Micron is probably a factor as well in all of this, in terms of the performance we're going to see there. So maybe that's the reason why ASML is up as strongly as it is. But a 4% move in ASML is a chunky move. But it's SAP's in the mix as well. So it feels like there's some kind of broader tech narrative as well. Let's talk about BMW. Let's talk about the car sector a little bit more. BMW BMW pre-released, but we now get we get more details now.
Yeah, absolutely. We've got a bit more detail from the business about how they're performing, and we've also got European car sales for the month of February. That gives us the broader picture. But let's focus in on the BMW story. The company saying its premium electric vehicles will continue to drive growth this year, even as global demand for EVs cools. The German luxury car maker says it expects a margin of 8 to 10% for its automotive segment this year. Bloomberg's Oliver Crook spoke to BMW CEO Oliver Zipser.
We had a solid growth here of more than 6% on the combustion engine side, but even more so on the pure electric side. And we had that growth despite headwinds, which already existed last year. And we had growth, but at the same time, we have a record EBIT in 23. So what we always said, we want to grow, we want to profitably grow, and that is what we achieved in 23. And with that, with that wind, we will continue growth in 24, what we announced this morning. We will see slight growth on the BEV side, stronger than on the combustion engine side, but combined with the main regions, United States, North America, Europe, and China. And we will see growth specifically on the BEV side. That sentiment we see that people don't want BEV, we don't see that, especially when you look at 24, January, February. We're quite optimistic, especially about the BEVs and the upper premium segment.
And that's what I was going to ask you. What are you seeing so far in the first quarter as a sort of harbinger for what we can expect for this year to come? Where are the strongest markets right now?
When you look, for example, for the United States, alone the BEVs grew by 100% in January, February. We had growth on the BEV side, 40% in Europe and about 20% in China. So all regions are growing. We don't see any shrinkages. We see in some regions less growth, but that doesn't mean that we are shrinking. That's something completely different. So we see growth in all regions. On the ICE side, but also, of course, on the electric side in January, February. And now we have to see, you know, what's happening in March and then in the second quarter. It's still early times, but currently we are quite optimistic that over the year we will achieve growth.
And I want to ask you a little bit about the material costs. This is something else we're hearing from auto executives, that is rising. Where in your supply chain are you feeling that the most?
Well, we had a peak on the cost of supply chain, especially on the battery side, mid-23. But this is coming down rapidly, you know, and that also has to do that market sentiment is a little bit lower, but that doesn't mean that growth is not there. It's just less growth, and that has a price effect. So I'm not so much worried about the battery costs on the raw material side anymore. And of course, with product substance rising, materials costs will rise, and up to now we were quite capable and putting that into a pricing mechanism. And raw materials, you know, they go up and down. Currently, they're going down. They're not going up anymore. So I think we have a realistic view on the developments, and we still can make a business case out of it.
Bloomberg's Oliver Crook there, speaking to BMW CEO Oliver Zipser. Let's get more on the auto sector. Bloomberg's global car czar, Craig Tudell, joins us here in London. And we'll start, Craig, good morning, with the details of what we've heard from BMW today. This is one of the last of the earnings stories to come through, isn't it? We've heard Q4 and full-year earnings from a number of places. Are we seeing the same themes play out here? He seemed to be talking about BEVs, as he calls them, but EVs, essentially, and how they still believe in that as the path for growth.
Yeah, I think the fact that BMW is able to deliver steady earnings at a time when it's investing, you know, it's looking at 2024 as being a peak investment year for the automotive business. The fact that they're putting so much investment toward moving to dedicated platforms for electric vehicles, they've been a real sort of surprise in that they've not necessarily gone with both feet in and you know, offered battery electric vehicles that have some of the same underpinnings as plug-in hybrid or even combustion cars. A lot of people didn't think that was going to work, that was going to lead to some real drawbacks to what they were offering for EVs, but they are well ahead of Mercedes and Audi in terms of their electric vehicle sales. They've surprised in that respect, and they're kind of known as the company that, really executes well and are kind of living up to that reputation at this time of a lot of tumult for the industry.
You talked about the execution ability relative to their rivals. What flips that, though? What gets in the way of that? What are the risk factors here where they could actually stumble a little bit?
It's going to be really a big test for them to move to this new Node class platform toward the end of next year. Even the best executors in the business, when you switch over to a new platform, it's a hugely complex undertaking that even the companies that have been at this for over a century, it's I would say, not just common, it is sort of the exception to not have any problems. And so there will be some challenges that they have to manage through. Of course, it will probably mean, really cranking production ahead of that changeover. And so perhaps we'll see, some inventory build to give themselves a little bit of a buffer going into that transition. But that's going to be something to watch, is whether they can pull that off with relatively few problems.
Is the takeaway from the European car data today that EVs are still an upper-end product? What's the kind of news from those numbers?
Yeah, I mean, I think it's interesting to see, European car sales continue to grow. We had a little bit of a blip in December, but at this point now, well over a year of consecutive gains on a year-over-year basis for Europe. I don't think that EV sales were particularly strong for the month of February, where it was really just kind of treading water with the rest of the industry. And so I think we are seeing a real sort of pullback in terms of the growth that we were used to seeing. And I think a lot of that has to do with the fact that Germany and France in particular have taken some of the subsidies out of the equation. I think we're seeing over and over again that, EVs are not ready to stand on their own 2 feet.
Still not a self-sustaining part of the market. That's the real takeaway. Craig, as ever, fantastic. Thank you very much indeed. Bloomberg's Craig Trudell. Quick look at the 6 stocks we watch every time at this point, just to get an idea of kind of what the bigger stocks are looking like here in Europe. Sensational 6. This is the picture. So Nova's a little bit weak this morning. The luxury stocks are bouncing back. That's the narrative as well. So you're seeing LVMH, etc., bounce back from yesterday's move. But as you can see, broad green on the screen. ASML is up. You got the Micron story to factor in there, plus a broad kind of story out of the Nasdaq yesterday, which needs to be priced in as well. But luxury comes back strongly today after yesterday's down move generated by Kering and that story about what is happening at Gucci. But Nova is quite soft this morning. Like a 2.2 move down on Novo is not insignificant.
It's not insignificant. You wonder if this is that sector repositioning we were talking about at the top of the hour. They're getting into tech because of that interest rate assumption post the Fed. The Micron numbers, as you mentioned, Guy, clearly helping pre-market. We've got that this hour, of course, because of the clock changes. And Micron really soaring. Really fascinating to see where the AI growth story, it isn't just NVIDIA. There are other businesses that are doing really well on the back of that trend.
There really are, but I think there's a question of when does that kind of momentum stop? And I think people keep waiting for that to happen. I think today's a great example of the fact that it's not, even if you have some of the stock markets hit record highs, the party continues.
Let's get to some of the big movers on the European session then. Individual stocks on the move this morning. Joe Easton has a briefing. Joe.
So we got breaking news in the UK. Next shares are hitting a record high this morning. They're up another 3.6% after earnings. The firm predicting around £1 billion worth of profit. The big thing, as we said in Stocks to Watch, is the full price sales are remaining strong. So goods and clothing that aren't discounted. And as I say, that stock continuing to rally. And we are seeing a read-through alongside the broader positivity in markets in the other UK retailers. Primark, Frasers Group and H&M also gaining as well at the moment. AB Foods, the owner of Primark, up around 2% at the moment. We'll flip over, though, have another look at those chip stocks. You mentioned ASML. This is pretty much a read-through from the Fed, but also the Micron gain, 18% for the maker of chips that go into PCs and smartphones. So that is boosting the sector as well. Infineon, ST Micro also gaining in the more traditional chip space. So a number of those stocks moving higher today. We'll have a look at a couple of deals because we've got confirmation of Virgin Money and Nationwide, the merger there, Nationwide buying Virgin Money. The stock is rising another 2.5%. It's 220 pence a share. We haven't actually gotten to that level yet, suggesting potentially a bit of risk of that not going through maybe. But this will transform the UK mortgage market. Together, the firms will have a bigger mortgage market share than NatWest, just telling you how much of a share they will have And we've got a discounted share placing today for Nexi. This is the Italian payments processing firm, an investor offloading some stock there. And that one is coming down at 2%. And we've got some decent broker moves today. Over in the drink space, Remy Cointreau gets a buy at Deutsche Bank. They also upgrade Pernod Ricard. That one goes up to hold. They say that the decline in Chinese demand has probably bottomed now, and that might be a reason to get back in. So that's one of the better performing drink stocks today for Remy. Also keep an eye on Pernod as well. And we've done IAG once again, a fourth upgrade this month alone for the company. This time RBC saying that the company has the second best margins across the entire European airline space. Only Ryanair has better profit margins according to the firm, and IAG up another 2.8% this morning.
Joe Easton from our equities team, we thank you so much for walking us through some of the major movers today. We should talk about the retail space in particular. We talk a lot of it from a macro perspective and whether or not this consumer resilience story we're hearing out of the States is the one that is mirrored on this side of the Atlantic. Then you get some pretty interesting numbers coming out of Next.
Yeah, absolutely. I mean, real wages.
You sound actually quite surprised by it.
Well, real wages is where this goes from a macro perspective, isn't it? And maybe this is we've been so busy thinking about, especially in the UK context, but you can apply it to other geographies as well. So busy sort of being in recession and feeling in recession over the last 2 quarters. But real wages is the story of 2024.
Absolutely, and that's something the Bank of England. Let's fold it into the Bank of England narrative, which is, do I cut rates at a point at which maybe actually real wages are catching up, and you'll start to see that effect.
You know who you sound
maybe
like?
Coming through. Who do I sound like?
So that's Catherine Mann, part of Catherine Mann's argument, isn't it? And we think that was what our guest in the 7 o'clock was telling us, that was one of the reasons.
I'm in good company.
To be
huge fan of Catherine Mann.
Yeah, well, you're just bringing that perspective is useful.
Well, I'm going to go from the UK to what we're getting in France, because you're seeing a big move off the euro. That French PMI data coming out as well. The March manufacturing PMI is coming in at about 45.8. The forecast was 47.5, so a little bit of weakness there. The services PMI falling to about 47.8. The forecast there as well, 48.8. Again, euro dollar dropping on the 109.16.
Bouncing along the bottom narrative. I mean, that looks,
the manufacturing,
weaker than the bottom has dropped again.
That's a much more ugly number on the manufacturing side than I think anybody was anticipating. Getting into the 45s is definitely not pretty. And this maybe speaks against this narrative that we're getting this manufacturing recovery that we've talked about. Certainly you're starting to see that in the States. That's a pretty ugly number. And that maybe just augments this idea that the ECB has to go before the Fed. Is there a risk that the Fed still only goes twice? But the data increasingly points to this idea that the ECB is going to, when it goes, is also going to have to go quite quickly.
The case for cutting changes central bank to central bank, and that's where this idea that they're all on the same page or getting on the same page is flawed. And the argument that for the United States, the case for a rate cut is normalizing. It's an insurance rate cut, perhaps. For Europe, it is a case of need. For the BOE, it's a case of need.
Just looking back at a chart of the manufacturing PMI data for France, and we've only been above the 50 line, which of course means expansion, a couple of times. We were before June of 2022, of course. Post-pandemic, there was that recovery. But then since then, only a couple of months have been above 50, and all the rest of the time has been sort of caught in a downdraft to December of last year. And then we bounced, and we thought maybe we were bouncing, and that was it. And now today, we see this data coming in pretty negatively. And no surprise, the euro drops. But of course, the size of that move, not enormous.
It is not enormous. And again, it speaks to that low FX vol thing, because you're kind of getting the same message over and over and over again, and yet very limited reaction. What are FX traders waiting for? That's what I want to know. That's what you guys should be IBing us as we continue the rest of the show. Speaking of, let's talk about what's next on the program. As the Fed stays the course, could those other central banks surprise? What's the trade there? We're going to dive into the details next. This is Bloomberg.
young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Or other authorities.
Could face bigger challenges.
Britain's next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Welcome back. 20 minutes into the market session here in Europe. Jay Powell told us to buy stocks, I joke, and the market is buying stocks. That certainly seems to be the takeaway from yesterday, a little bit of catch-up here in Europe. What do you do with the bond story, though? That was interesting. That was a little bit maybe more nuanced. So let's get a take on what is happening here. Kim Crawford, Portfolio Manager, JP Morgan Asset Management, joins us now. So what do I do now? I'm interested in buying bonds. I'm thinking about what's happening with bonds. Do I buy at the front end? Because, yeah, Powell's told us it's 3. It's going to be 3. Therefore, we need to price that into the front end. What do I do with the back end as well? Because growth's going to be higher, inflation's going to be higher. So what do I do with duration here?
I think for us, it's still a constructive duration picture if you're a medium-term investor. You still lock in a good level of income after the big rise in yields that we've had. And then you lock in diversification. You know, what if the growth data suddenly rolls over more than the market expects? Then you're looking at double-digit returns in bonds. So I think as a medium-term investor, multi-asset portfolio, you still want to have exposure to government bonds right now, even though the narrative is being challenged. And then it's how much volatility do you want? If the Fed starts cutting rates, the front end's going to do better, the curve's going to steepen. But how convinced are you right now on that narrative?
Okay, how convinced are you? Let's turn that question around.
The way I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2. Ideally, it's 3 and greater. So if you were to look at a single person, a person has a set of core values. They may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values. Personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits That's like, again, like a super organism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Of issuance, we still have QT and passive in the background, but I think the macros still matter more. I still think it's going to be growth, it's going to be inflation, but we just need convincing data in one side to really break us out of the range.
Give us a range then for the 10-year. What should we be looking at?
So for us, if it's a soft landing, we're looking at about 3.5%. But if this inflation narrative keeps building and we're really actually seeing a reacceleration in inflation and growth, then we'll probably step in at about 450 again. So we think yields are still much closer to the top than they are at the bottom. We're confident that the last hike was behind us. The next is going to be a cut, and it's just a matter of the timing.
Kim, can I take you to the UK conversation? We've been talking about one, micro story this morning that we found interesting, which is around the retailer Next, and they're talking about wages and particularly real wages adding a boost to their business. And I wonder if, to what extent is the real wage story in the UK a kind of upside risk on inflation? Because the counter to that, I suppose, is we know a lot about what energy prices for retail customers are going to do, and that gives a lot of people comfort to say that inflation will be below 2% come April. So how do we look ahead on the inflation story in the UK?
Yeah, so real wages have been boosted in Q1 because inflation's come down a lot quicker. Wages have stayed sticky. So we are seeing that little boost. We had negative GDP growth last year, and we're seeing that move into slightly positive numbers. For us, that's still a sub-trend growth story, a bit of improvement, but still sub-trend. So we're not concerned about that from an inflation front. And what the Bank of England cares more about is inflation. Is it going to come down as quickly as they expect? And I think they've got encouraging data since the last meeting. Services inflation has been in line with their forecasts, and the labour market has continued to loosen. And we've got really good news on wages as well. We even had a negative private sector wage growth month-on-month number. And I know that data is volatile, but for a January print, which is usually the strongest for the year, to get a negative number, I wonder if there's something else going on under the headline numbers.
Okay, a quick word on where the ECB goes, because we've got that French manufacturing PMI number that came in really low with a 45 handle just moments ago. We're waiting for a build-up of the picture across Europe, of course. There does seem to be a risk that instead of bouncing out of recession, Europe, is still down there.
Yeah, we agree on that. I think if you look at US, UK, Europe, US narrative is being challenged the most. UK sits in the middle. And Europe is where we think the disinflation, lower growth narrative is the strongest. So we do like owning bonds in Europe as well. Similar to the UK, it's getting a bit of that real income boost to services for Q1. But it does look like if you're looking for a central bank that might do consecutive cuts, the ECB is probably closest to it because of the weaker growth narrative.
Okay, thanks so much, Kim. Kim Crawford, Portfolio Manager at JP Morgan Asset Management. We need to keep an eye on what's going on in Switzerland.
We're about to see the S&B decision. This could be the surprise. This could be where the shock comes through. Some people believe it's going to be the Bank of England a little bit later on.
Look how excited you're getting.
It's catching, clearly, Chrissy. Yesterday we underplayed maybe the excitement.
They were overdoing it.
Pretty
Quite
decided
possibly.
that. Yeah.
We'll make the most of it.
Switzerland snooze fest? Definitely not. That's not what's going to happen. Anyway, we're going to be keeping an eye on what happens to the S&B. The rate decision is next. This is Bloomberg.
On the product may read made in the USA, but the sign on the CEO's door often says made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level up your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Of that pair as well. And you are seeing, interestingly enough, German manufacturing PMIs come through with a, get this, 41 handle, which for a big manufacturing powerhouse is an ugly, ugly number. The services print, though, comes in higher than anticipated, so sticky inflation, which means that the comp number actually picks up, but weak manufacturing data. But nevertheless, the story really is one of a surprise out of the S&B. Let's go to Zurich. Let's get some analysis. Carsten Junius, chief economist at Safra Saracen, joins us now. He called it. Carsten, this is the right decision in your view. Why?
Well, absolute fantastic. There are so few people that believe me that the S&P would deliver that rate cut. So you really find me totally enthusiastic. I also appreciate the reaction that you reported on the euro Swiss franc. Also, that is the right direction because the Swiss franc was overvalued in real times. Monetary policy was restrictive. And the economy was growing below potential. Well, that might be the case for other countries as well, but one thing stands out in Switzerland. The Swiss National Bank managed to bring inflation down towards its target. Actually, it was in the middle of the target range. I thought that the balance of risk was also balanced for the coming quarters, simply because wages don't grow as much as in other countries. So right decision, and well, I love it.
Is there more to come? Is this one and wait? Is this one and done? Is this one followed by two?
So we expect 2 more rate cuts this year. So possibly in September and in June and September. I could imagine that in the press conference later on, President Jordan leaves this as an open question and just indicates that they have to monitor data and developments as well. So in a similar data-dependent way as all other central banks communicate these days. We have to bear in mind that rents, which are partly administered in Switzerland, will show another jump in May. So the wonderful in the short term, inflation might pick up. So I could imagine that pre-committing before such a small inflation spike wouldn't be the best thing President Jordan should do.
Can I ask you, good morning to you, Carsten. We're hearing from them on a number of fronts, and the S&B saying they're willing, as Kriti said, willing to be active in foreign exchange. What does that mean to you? What would you expect the S&B to be doing on that front?
So I thought that they might have intervened in the past 2 months, simply because they actually stressed a couple of times that they don't like that the Swiss franc is so strong. And so let me emphasize this. It's not only strong in nominal terms. That's something that we are used to. But it's also strong in real terms, hence adjusting for the inflation differential. And that was weighing very much on Swiss exporters, on the Swiss manufacturing sector, which is not in a good situation. I could imagine that the Swiss National Bank will reinforce the latest trend that we have seen in the Swiss franc and tries to push maybe or closer towards a parity towards the euro, which I would consider to be a fair value of the Swiss franc right now. So we still might have 2 cents to them.
Carsten, it's really interesting to see that the S&B has moved then ahead of the ECB, ahead of the Fed, that they've got their own dynamics going on, of course. We've seen that happen previously. So I know that a couple of years ago we saw the S&B move before the ECB when it came to the rate hiking cycle. What read across are you looking for? I know you're focused on Switzerland, but what does this mean, do you think, for other central banks?
Well, basically, more or less, nothing. It just means that the S&B is a bit more courageous and rightly focuses on the domestic data sector. So when I had a discussion with investors and colleagues, they all point out that we have still inflationary pressure. And that is true for the US and it's true for the euro area and the UK. But the Swiss National Bank, simply, they focus on their own data sector. And when watching them, it's actually, I don't think it's so difficult to predict them. You only have to just shut out all these external influence and focus on the Swiss data. And here we are clear. We were so when they first hiked. I think that was a bold decision. But also last September, when they actually, contrary to the ECB, said, okay, we are not hiking anymore. And it also was another right decision. So they act independently of these other central banks, and that we have to bear in mind. With a better inflation picture in Switzerland, I think we shouldn't draw too many lessons for other countries that have simply a different and worse inflation environment.
Well, Carsten Creedy in London, let's talk a little bit about what this means in terms of their buying as well, in terms of how they're interacting with the U.S. bond market, the U.S. equity market as well. The S&B has always been out front on that. Does this impact that strategy?
No, I think you mean how they manage their assets. Now I think they have a fixed quota on equities and don't deviate in a discretionary way from their asset management policy. So that is fixed. The only discretionary element that comes in is when they intervene in FX markets. And as said, I would expect that they might continue to try to weaken the Swiss franc in the next couple of weeks and months, and that's it.
Carsten, give us a number on that. When you talk about that weakness in the FX story, what level raises those red flags on the upside and on the downside?
Well, see, I think so. According to my calculation, the Swiss franc is still around 4% overvalued in real terms. Over time, this might diminish or would diminish as we still have this inflation differential. But short term, I think we have, I would expect something. I could imagine that we're going up to 99 cents versus the euro, so landing shortly before before parity. Versus the US dollar, it's more tricky, and it's also not the main trading partner of Switzerland. So most of the trade is with the euro area, hence that is the important currency pair. And on the
let's
downside,
just talk a little
honestly,
about where we go.
I don't think that the Swiss franc would strengthen in the next couple of months. I could imagine that in the second half of the year, once they are more done with their rate cuts, then we see something, but not yet.
Carsten, Jay Powell indicated last night that he didn't believe that we were going back to pre-pandemic rate levels. Do you think that applies as well to the S&B? Do you think how is the negative rates experiment viewed in Switzerland, and do you think that is something that we could ever see coming back?
No, I think no one wants that. We don't want. And I think yesterday, or was it with the Bank of Japan step that we had on Tuesday, I think we are officially out of a deflationary environment. I think it was such a great step for the world economy that the last stronghold of deflation also is, so that is also over. What I found interesting in the dot plots yesterday was basically that they also decreased their rate cut expectations for 25 and 26. And this goes into the direction that you mentioned. We are not going to be at these low interest rate levels, as we have seen that a big economy like the US can actually grow quite healthily with an elevated interest rate level.
Carsten, we'll let you go outside. You can have your little victory lap and then come back and we'll maybe talk again very soon. Thank you very much indeed. Carsten Junius, Chief Economist at Sanford Saracen, joining us. He called it. That's what we got. A cut from the S&B. The swan song, you could argue, of the S&B president, Thomas Jordan. He is going to be speaking to Bloomberg a little later after the press conference, which starts at 9 o'clock UK time, 10 o'clock in Switzerland. And we're going to have coverage of the Norwegian Central Bank decision a little bit later on as well. That's 9 a.m. as well. Francine is going to be taking you through all of that. Plus, she's got some great guests to talk about all of this. Philip Hildebrand, formerly of the S&B, is going to break down all of these central bank decisions in the 9 o'clock hour.
Oh, phew. Well, that was exciting.
Deep breath.
Deep breath. We need to tackle something else that you referenced. You did mention this earlier on, Guy, but maybe we just give it a little more thought. This is the German data that we got out at the bottom of the hour as well. The German manufacturing story looking really weak, 41.6. The forecast was 43. So this is the German manufacturing story in contraction. But really fascinating that the services story does much better than, better at least than expected. Still below 50.
Nearly 50, but it's nearly at 50.
Yeah, we're nearly in expansion territory for services. businesses in Germany. I mean, we know the negativity around the German manufacturing story, all the challenges around energy supply that have been thrown at that economy. I wonder if this hides something more structural that's happening, or we're just still waiting for that bounce back.
I think wages are the interesting story in Germany. And we're about to see, we've got more strikes coming through. We're watching what is happening there. The wage round has been quite fruitful for the unions, you could argue. So is there a real wage story that actually is driving maybe that service side of the economy?
I mean, that seems to be the trend elsewhere, but then some would argue that the other side of that is the import inflation risk that you had. That was what Carsten was talking about with the Swiss economy as well. How much of that is more contagion around the rest of Europe? Okay,
coming up on the programme, we'll get back to the Bank of England conversation, a BOE decision expected today. We'll talk about that, but also about the broader UK economic story. Hannah Bernard joins us, Barclays UK Head of Business Banking. We will talk about the UK economy, but also government plans to back female founders. We know she has plenty to say on that subject. More next. This is Bloomberg.
Capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
I think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today, 46 minutes into a European equity session that is getting that post-Fed bounce. It's getting complicated because there are a lot of inputs this morning. Post the Fed, we're getting that bounce in risk sentiment that we saw boosting stocks stateside. We've had a cut from the SNB. Does that get people thinking about where these cuts go next? Although we were warned by our last guest not to read too much across into other geographies. But then we continue to get really quite negative data coming through on the manufacturing side, certainly in France and Germany. So there's a lot to think about. Further ahead, we have the Bank of England decision coming up today. We're going to be taking a look at the UK business landscape, of course, in that context, and also the outlook for small and medium medium-sized businesses. Joining us now for more is Hannah Bernard, Barclays UK Head of Business Banking, who is also head of the recently launched Government Female Founders Task Force, and it's there we will start our conversation. Hannah, really nice to see you. So let's talk about this this initiative then that you are working on. There's a long history of these kinds of initiatives, which is a good thing. We're focusing on them, but also it suggests it's not been easy to do in the past to make a real difference in the amount of money at early stage going to female-backed businesses. What are you going to be working on?
Yeah, so first of all, I'm delighted to be here. Thank you for having me. And I am going to be co-chair of the Investing Women Task Force with Debbie Wasco, who's a very successful female entrepreneur in her own right. So it's been fantastic to have the two of us brought together to do the co-chair. So our aim is to make the UK the best place in the world for female-led businesses to start up and scale up. And to your point, there have been reviews before, but the Rose Review did a brilliant job of laying the foundations. They've done a lot of work in terms of the Invest in Women Code. Now is the time for the next phase, which is about that laser focus on the funding gap that female entrepreneurs face. And so we're being very, very specific and targeted to make sure that we have funding as our primary goal, front and centre, and that's the £250 million initial target we've set to try and get a funding pot allocated to women businesses, to female businesses across the whole spectrum. So from micro funding, sort of like the grant scheme, angel investment, we've got a big issue there, right the way through to venture capital and making sure that we get a due allocation there.
Okay, and thinking about all those stages of early, the early process of allocating money towards female businesses, I know that previous reviews here have just recommended things as simple as having more women making decisions about where VC money goes or other pots of money, where that goes to. I mean, it can't be as simple as women only do business for women and men do business for men, but it's amazing to think that that can make such a difference. Do you have expectations for that kind of change?
I mean, I think so. It's a thorny topic, isn't it? So 11% of investment committees for venture capitalists are female, and we know that women are more likely to back women because they may understand the industry or the sector, and so they feel more comfortable. So there's definitely a piece that over time we would love to see greater diversity of decision makers, absolutely. I think to make meaningful change quickly, though, we need to start to think about what's the outcome we're trying to get to. How do we get the funds in place that will give us targeted pots to go after? And then how do we put in structures or incentives and like matched funding? We need to give some kind of benefits to the male VC partners, frankly, to want to invest in female-led businesses. And we know the returns generated can be up to 35% better for female-led businesses than for male-only businesses. So there's definitely an economic rationale. We just need, I think, to provide a bit of extra encouragement to make sure that we start to get this kickstart.
Let's widen the lens a little bit. What impact could this have on the economy? Is this new money that's going to be, you're talking about here? Because the UK economy is desperately needed of investment broadly.
Yeah.
So you can get this fresh money in. What's the kind of the kicker? What's the kind of the read across into the wider economy, do you think?
Yeah, I mean, so we absolutely need UK growth, and that's the thing that I think everyone can be agreed on. And we believe that there's latent potential in the female business market that isn't being unleashed because we haven't got investment going into those businesses. So we do want to try and find new money. There's an example where we want to have a conversation with the Mansion House Compact signatories. They've committed $50 billion to go into unlisted equities over the next 5 years. If they gave just 0.5% that was going to be earmarked for female businesses, then that would get us our £250 million funding pot. So the idea is very much finding new money to go into female businesses so that we can then turbocharge that potential.
Is the cost of money a problem? That takes us to the Bank of England. Is there a kind of cost of money problem issue here as well?
I think the biggest problem is actually just access. I think we need to solve that first. And then, of course, the whole piece around the rate environment is stability counts. So businesses need to be able to plan into a steady environment. And I think having some certainty around policy stability, rate stability, those sorts of things are all things that give small business owners confidence to sort of plan ahead and decide where they're going to make investments.
It's so funny. You say we want stability. We had, I believe, one of the CEOs of the biggest Australian pension funds investing in the UK in a really big way. And he said, well, the UK is already stable as part of their base case for investing. I'm curious what stability looks like. What do you need to see to really attract more of that business?
Yeah. So, I'll tell you, because I represent 1 million small business owners, so they will say it's hard to plan if they think they don't know which way the rates are going. So I take your point, like macroeconomic view, you kind of go, well, it's actually relatively stable. It is. But for a small business owner, not knowing whether now is the right time to invest, what could be on the horizon, they need a degree of confidence that they can kind of have at least a kind of short to medium term view of where things are going.
So how are they coping with that? What's the status report there?
Yeah, so I mean, I would say they're cautiously optimistic at the moment. They're pleased. The inflation, yeah. The inflation piece clearly is a really good picture, and then the base rate piece I think has stabilised now, and I think businesses are starting to feel much more able to plan, able to invest. So their surveys are definitely on the up. They're feeling much better than they have for a while.
All right. Hannah Bernard, Barclays UK's head of business banking. We thank you so much for joining on set and giving us a little bit of a check-in on the UK economy. In the meantime, we should recap some of the data that we got, because we did get a ton, and it doesn't stop just yet. We got the French PMIs, we got the German PMIs. Germany doing just a little bit better than expected. The French PMIs dropping quite substantially, weighing on the euro, by the way. So you're seeing euro dollar at about a 108 handle. Yeah. Still range bound, but weakness today.
Yeah, and this does feed expectations that, that pickup in activity that maybe we'd seen on the manufacturing side over the last month or so in some of this European data. We're going to have to wait longer for that. It's not being delivered as quickly as we thought it might have been. Still
with the sticky services inflation, though. I think that's kind of a sticky sort of services side of the economy, and I think that's interesting. That continues to power the story. We're going to get UK data as well at 9:30. That's going to precede the Bank of England decision a little bit later on, so going to watch that as well. The real story, and you're getting a big move in euro dollar this morning. This Swiss franc decision, I think, is this S&B decision that's impacting the franc, I think, is fascinating as well. Is this isolated? Is this idiosyncratic? Carsten Junius was kind of suggesting that maybe it is.
Yes.
But does it speak to a wider disinflationary story in Europe that actually other central banks are going to have to follow as well?
Yeah, because you were flagging this as, this is going to be the first of these major central banks that goes ahead and starts cutting rates.
Yeah.
The point that Carsten was making was that inflation is only 1.2% in Switzerland. So it is a different dynamic, but you've got weak growth data coming out of Europe once again. It takes your mind to the ECB.
It absolutely takes your mind to the ECB. And then there's so much concern about the ECB front running the Federal Reserve. So there's kind of a domino effect here that even though Carsten says is a Switzerland-specific problem, very easily could spread into a global economy problem in just 12 months' time.
And there's all kinds of risk factors out there as well. I keep harking back to Bruce Richards' warning on what is happening with the commercial real estate story and how that feeds through into the US banks. There seems to be this kind of consensus, Goldilocks narrative, warm fuzzy blankets, kind of, the market is happy right now. Where are the risks that we're not talking about lying? Yesterday was a great case in point. Who'd have expected that the Fed was actually not going to move this year's dot, but next year's dot? And there's all kinds of... It does seem as if the market is very comfortable in this kind of consensus narrative at the moment.
We did spend a little time talking about that possibility on the show, but you're right, the focus was on 2024 rather than the longer-term story, but it was mentioned. I think we've covered a lot of ground in this programme, from S&P rate cuts to the data coming out, to plenty of corporate stories and plenty of geopolitics as well. We've covered the banking stories as well, and I wonder where that takes us, because there's this really interesting theme of cutting jobs on investment banking, and yet we've got IPOs coming. We've got the Reddit IPO. We're talking about capital markets activity. Plenty of M&A been happening recently. It's not a rebound to the glory days, but it's better than the end of last year.
Yeah, it kind of feels like even on the banking front, even on the central banking front, the theme seems to be dipping a toe in the water and seeing how we feel. And it kind of, the S&B, I think, served that purpose today on the monetary front. Reddit serving that purpose on the IPO front.
What have we got coming up? So we're about to get the S&B press conference, which I think would be really interesting. The explanation around this from Thomas Jordan up in Bern, I think, will be really fascinating.
Yeah.
Then we get that other data as well coming out, and we're looking forward to the Bank of England.
Absolutely. We will also be covering the Norges Bank for you. We'll have full coverage of the Norwegian Central Bank's rate decision. That's due at 9 a.m. UK time, so that's actually in 4 minutes' time, just in case this morning was not busy enough for you. We'll be also talking, Francine Lacroix will be talking to the BlackRock Vice Chairman, has important Swiss perspective to bring, Swiss experience to bring to this. Philip Hildebrand on the pulse, that conversation coming up shortly. As Guy mentioned, the S&B President, Thomas Jordan, will speak to Bloomberg after that policy decision that surprised all but 5 economists, it seems, this morning, because everybody else was lined up for something different.
We're in the volatility business. We love a bit of a surprise. Keep an eye on Nocky Stocky over the next few minutes as well. That's Critty's other favourite from this morning. The pulse is next. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The S&P surprises some, becoming the first major central bank to cut rates, while markets now turn to other decisions, with the BOE and Norges Bank largely seen holding. European stocks and U.S. futures trade higher following another record for the S&P 500 after the Fed maintains its outlook for 3 rate cuts this year. Plus, Bloomberg learns that Barclays is planning to cut several hundred jobs within its investment bank division as part of an effort to trim costs and boost profits. Now, let's take a look at the European markets map. Again, the focus is on this marathon, really, of central banks. The Swiss franc has been on a downward path against the dollar since the start of the year. This is from our Venram. Today's surprise interest rate cut, as well as the central bank's lowered inflation estimate to 1.4% from 2%, will probably further accelerate the decline. Now, we have an expert voice on this shortly, so I'm looking forward to speaking to Philip Hildebrand in a second. But you can see for the moment, we're seeing gains across the board. We're also looking at AI. We're looking at tech. It's a big old news flow day because we're also expecting the DOJ today to go after Apple because of its monopoly concerns. S&P futures for the moment gaining 0.4%. We're also seeing a little bit of a liftoff for the Nasdaq 100 and then European stocks getting 0.8%. A couple of other things we're watching out for. So again, it's all about central banks. It's a lot about what we heard from the Fed. Maybe not as hawkish as they could have been. Certainly, if you look at the dot plot, that's changed a little bit. And look at gold. It's the first time ever that we touched $2,200 an ounce. Swiss franc 0.9749. Norges Bank leaving the benchmark interest rate at 4.5%, so no change for Norway. Norwegian krona 11.4924. And then we go into the Bank of England. Also, no expectation in change. And if you look at the communication of Andrew Bailey, it's certainly been a lot more tentative, or maybe not as clear in terms of a timeline that we heard from the Fed
Fed and the ECB. Then we also have some news in terms of data. Euro area March manufacturing PMI coming in at 45.7. The forecast was a touch higher, but remember, anything below 50 still means a contraction. Again, that PMI, though, services, so manufacturing is not great. Services PMI rising to 51.1, and that's better than expected. So to the news of the day, the Swiss National Bank has cut its key interest rate by 25 basis points, acting months before global peers may follow suit. Now, it's a huge week for central banks with the Fed decision yesterday, the S&P and Norges today, the BOE coming shortly. So for more on all of this, to make sense of it all, really, let's bring in the Vice Chair of BlackRock, Philip Hildebrand, who joins us for an exclusive conversation, also who knows the S&P and actually the Swiss complex intimately. So, Philip, what a treat, what a day to have you on. As I mean, it feels like momentous because it's the first major central bank to cut rates.
Yeah, we've been waiting for this for a long time. The market has been pricing it and had to come off it now. Basically, the first one is out of the gates. Not surprisingly that it's the S&P, in the sense that Switzerland had by far the best inflation record through this difficult period of the pandemic. So it's a courageous step, but perfectly justifiable when you look at the inflation forecast and the inflation data these last couple of years.
So what does a policy mistake look like, not from S&P, but also for others? Is there a danger that actually if you cut too quickly, then inflation actually is rampant under control, and so it makes your job double harder to get on top of that?
I think the main challenge they face, all the central banks effectively, and certainly the Fed, is that goods inflation continues to come down. That's the post-pandemic adjustment. That will settle at roughly zero, which is where typically historically goods inflation is. What is not going to happen, in my view, is service inflation is not going to come down. We have very strong labor markets. Wages are strong. And so my guess is service inflation is going to turn out to be sticky when it settles. And in combination between goods at zero and service inflation somewhere around 3%, let's say, that suggests to me that what we're going to end up with a kind of a rate that is going to be higher. And so I think what you're going to see is a higher for longer story that will ultimately kind of feed through the short-term adjustment of rates now beginning to ease, policy rates beginning to ease.
Philip, for many years, you were, of course, in charge of the S&B. We're now looking at live pictures of Thomas Jordan speaking to report. I know that room very well, gathered there to try and understand the path forward. He's also said he will step down. What's the intricacies on I guess, the complexities of just managing the Swiss economy right now?
Well, I think that, just keeping the track record of the S&B, the legacy of Thomas, of course, is that he has the best inflation track record of any central bank. And so I think that's the principal challenge going forward, to make sure that there's no question that credibility on inflation will be maintained. And then in the longer term, the question will be, and that's partly an S&B question, but more a regulatory question, how do you deal with a bank that is going to be very, very large compared to GDP? And that's, of course, the legacy, in a sense, of the failure of Credit Suisse. So those will be the main challenges going forward, I'd say, for his successor.
But would he be worried about market reaction right now?
No, I don't think so. I think he's, they've known
how the markets will react.
They know how to surprise markets. They've done that before. As I said, I think he could certainly perfectly justify the decision today. He could have also waited. But in a sense, when you look at the inflation data, the inflation forecast, there's not much point in waiting here, so why not go ahead? So I don't anticipate any problems. And if he gets a little bit of currency weakness out of this, then I think, that's perfectly fine. So this will not create any major kind of market reactions. But it does signal to the world that we have kind of turned a corner, that central banks are easing. And then the question will be, where does all this settle in the long term?
Yeah, but then if you look at actually what we heard from Jay Powell, he was quite tentative. Right, and again, he's a lot less hawkish, and even the dot plot gave us a lot less hawkishness that we could have seen.
Well, I think they've succeeded very well. Remember, when we last spoke in Davos, we had pricing in the market that was just not realistic. So the Fed has succeeded in squeezing that out. We're now looking at 3 cuts going forward. It seems pretty clear to me that the Fed is intent on cutting rates, so on following Thomas Jordan. And that will happen unless something terrible happens. What's also clear, though, when I look at the details of the charts, the dots going forward, that there is an implicit recognition that longer term, the inflation path and the interest rate path is going to be sticky. There's kind of an implicit recognition that we are likely going to see a higher neutral rate level. He didn't explicitly say that, but if you look at the dots, it's there. The inflation numbers were actually slightly adjusted upwards for the next 2 years to come. And I think that's going to be the real story here. We are going to touch 2%. Inflation is coming down quickly, but it's mostly a goods inflation story. The real question will be, where does service inflation settle going forward?
Yeah, and actually, this is, I mean, one of my favorite authors is John Authors, and he has beautifully laid out, of course, exactly what you're saying. What does it mean for the economy? And there's an assumption, base case, but frankly, completely priced in the markets, that we have a soft landing.
Well, we'll have, I think what we will not have is a kind of what I would call an immaculate landing. We're unlikely to get a perfect sort of 2% inflation, no weakness whatsoever, rates going back to levels that we've seen before. The supply constraints that you and I have talked a lot about in the last couple of years are still going to be there. So I think the challenge is, how do we get out of a kind of higher for longer environment with relatively sticky inflation, which will lead to a situation where, unlike in the past where central banks had a kind of permanent bias to ease, they may have a longer-term permanent bias to tighten. And one of the answers, of course, to this dilemma would be a boost in productivity. And I think that, to me, is the big kind of longer-term question. Do we get a boost in productivity coming from AI or something else that kind of gets us out of this constrained environment of relatively low growth, relatively high rates, and relatively sticky inflation?
Yeah, and productivity in the U.S. is actually on a tear. We're listening to Thomas Showdown of the S&P saying that they will, of course, adjust monetary policy again if necessary. How much do you look at gold, Philip? I mean, gold at a record high. I don't know if it's symptomatic of actually, traders or other central banks not trusting the Fed, and whether that's a debt problem.
Look, gold is always a kind of a gauge of risk and uncertainty in the world, and we live in a very uncertain, very risky world, not just with regard to where inflation will settle, but with regard to a new trade order, fractured geopolitics. We have wars going on. We have very high debt levels, undoubtedly. The U.S. Fiscal situation has deteriorated, of course, quite dramatically in the last couple of years. It has helped in terms of the resilience of growth. You can see that Europe has much weaker growth because it didn't get as much fiscal stimulus. The price to pay is the debt. So I do think there are just lots of sources of risk and uncertainty that are embedded in the global economy, and that's what I read into the gold price rather than any kind of monetary or policy implication per se.
Okay, Philip, thank you so much. Philip Hildebrand, of course, BlackRock's vice chair, stays with us. We'll talk maybe a little bit more about productivity and AI. Now, the outgoing S&P president, Thomas Showdown, will also speak to Bloomberg a little bit later on after the surprise rate cut. Now, on to some of the corporate news we're following. And Micron Technology surging pre-market after it actually gave a surprisingly strong revenue forecast for the current quarter, buoyed by demand by artificial intelligence hardware. Now, this is the largest U.S. maker of computer memory chips. It says fiscal third quarter revenue will be between $6.4 and $6.8 billion, topping the $6 billion penciled in by analysts. Now, Micron and rivals have had a tough time so far, and it seems that their fortunes are changing very rapidly. Much more to come. This is Bloomberg.
Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking. and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Still with us, BlackRock's Vice Chair, Philip Hildebrand. Philip, we're talking a little bit about, of course, the Fed. We're talking about productivity, some of the challenges, and we're certainly talking about the Swiss National Bank. It's a pretty big week, actually, because we have the SNB, the first major central bank to cut, and then we had the Bank of Japan. Now, it's largely gone unnoticed by the markets because it was telegraphed, but after 17 years, I mean, are there lessons that we take from BOJ and the way they tried to reflate the economy?
I think it's kind of a textbook case, frankly, of how you get out of an extremely long regime into a new one. Now, in practice, of course, it was kind of, as you said, it was gradual. Yeah. But nonetheless, I think it was done it was really a masterclass in how you move from a very entrenched policy stance to a new one while keeping all the options open and not rattling the market. So to me, this really was a masterclass by Governor Ueda.
When you look at some of the I guess the outside forces, it can be politics, it can be geopolitics, the resurgence or uncertainty surrounding China and its AI. How does that influence how the markets participate and what kind of economies we're left with?
The easiest way to think about it is if you look at a lot of what is priced in today, particularly in risky assets, there is a sense that we are going to somehow come out of this low growth, sticky inflation, high rate or higher rate environment. I think that assumption is implicit in the kind of very optimistic pricing that we see in markets, which, by the way, I think looks like it's set to continue given the Fed's communication yesterday. And implicit in that is something is going to help us get out of this supply-constrained world that leads to higher rates, lower growth, and stickier inflation. And the obvious candidate for it is, of course, a productivity boost that comes from AI. It could come from somewhere else. Productivity boosts, by definition, kind of come from innovation, which we can't predict. But that seems to be the most likely story. So I think the most interesting thing to do in the years and months and years to come is to sort of observe what can we see in the data that gives us more or less confidence that this unfolding of a productivity boost is actually going to happen. To put it differently, the world needs it desperately, frankly. Yeah. Because the new geopolitical regime of constrained production capacity is an uncomfortable one. And the one way to get out of it is you get a boost in productivity that then raises and increases production capacity of the world economy.
But is there a danger that actually the U.S. takes advantage of this more than anyone else? And we've seen the numbers, we've seen onshoring. We're questioning the end of multilateralism, and so you have a very strong U.S. economy. And the rest of the world is kind of scrapping for pieces.
There is a clear danger of that. If you look at the internet boom, right, that raised productivity probably by 15%, something like that, and of course created these enormous companies that we now all know in the U.S. And then we had the energy shock, which was a big disadvantage for Europe relative to the U.S. There's a risk on industrial competitiveness for Europe. I think that is in my view, very significant. So yes, I think this has to be a wake-up call for the rest of the world, particularly for Europe, to make sure that the next big boom, in a sense, that will create the next set of big companies, the next source of job growth, doesn't again happen almost entirely in the U.S. The tech story was largely missed by Europe, and the result is today you have almost, maybe one, if at all, kind of major tech company in Europe. What you want to make sure is that from a European perspective, that this doesn't happen again if AI is to be the next big source of productivity. We'll see. This is hard to predict, but I do think what we can say today is that the world needs, quite desperately in my view, a new source of productivity, a new boost to productivity so that we can overcome some of the constraints on production capacity that we see in the world economy as a result of the new fragmented world.
So we also know, of course, that BlackRock with the JP deal is trying to grow in private markets. So if this is the future, it changes also the way banks operate. I mean, it kind of changes the whole construct, right, of the financial world.
Yeah, I think we've seen for some time. We call this one of the several mega trends or mega forces. Of course, the kind of disintermediation, in essence, from the banking system towards capital markets, which has many advantages, but poses challenges, of course, for banks. And I think, one of the advantages here is that private markets are growing. One of the areas that the world is going to need desperately in the years to come is infrastructure. At a time when fiscal capabilities of the major countries are really strained, quite severely strained as a result of all the crisis fighting that we've had. And so the notion that you have to find ways to mobilize private capital, use public capital to incentivize it, and then mobilize private capital at scale in order to fund all the infrastructure investment needs that are clearly out there, whether it's in this country or, frankly, almost any other country, that we see as a great opportunity for our clients, which is why we've made a big effort to become a more important, significant player in the space of infrastructure investing.
$4.5 billion are going to the polls. The U.S. election probably the biggest one, where you could see the biggest shift. But there's the European Parliament elections. There's the UK. What does this mean for markets?
Well, it's a great source of uncertainty. I think for the world at large, it means, how do you think about the United States? Does the United States continue to be the guardian of sort of humanity's interests? Can you rely on the old security arrangements, even on the old monetary arrangements, the Bretton Woods system? You think about the international organizations. They all came out of a world where the U.S., in sort of enlightened self-interest, created a system that served the world well. And I think the big question that will be answered, not just in November this year, but frankly over the years to come, is to what extent do we continue to live in that kind of world, or are we really moving on a sustained basis to a much more fragmented world where different regions, different countries have to become, in essence, more self-reliant? And that would imply, of course, vast adjustment costs. Just think of security alone. If that were to be the case for Europe, this would imply major investments in security, a very different world. So, to me, the big question here is, I think it was Henry Kissinger who said the holiday from history is over at some point shortly before he passed. Do we have to prepare for a completely different world where the role of the United States is a different one than you and I and the previous generation have really become used to since World War II?
Philip, thank you so much. And of course, that goes to the cost of money and everything else. We'll have to get you back on really soon. I could speak to you for another 3 hours, but we do have other news to cover. Philip Hildebrand, the BlackRock Vice Chair. Now, coming up, the slump in global deal making continues. So we'll also bring you the latest on planned job cuts and at Barclays and Citigroup. That's next, and this is Bloomberg.
think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, Bloomberg has learned that Barclays and Citigroup are planning job cuts in their investment bank divisions. With us now is Bloomberg's Tom Metcalf, who oversees all of our banking coverage in Europe and the Middle East. So what do you make of these cuts? Good morning, first of all. What do you make of these cuts at Barclays?
Good morning. No, I think they're pretty big news. So, you know, these are, I would say, slightly different to the ones we see at Citi, which are much more linked to the sort of the deal-making environment. This is Barclays, you know, looking at the size of its investment bank and going, as we've seen with their strategy, how can we make our investment bank more efficient? So these are pretty sweeping, hundreds of jobs. Looks like they're going to be largely in, say, maybe the more capital-intensive environment, if we listen to what Venkat was saying on those things. So, you know, we knew something like this was probably brewing, given that strategy, but it is when you see it in, you know, sort of confirmed with hundreds of jobs, that's a big change.
It's a big change, but they still have global ambition. So how do they square the two?
And that's the challenge, right? That's what Barclays got to wrestle with. They're relatively effectively shrinking the investment bank within the size of the group. But how can they still keep that global ambition? They've been very clear that's what they want to do. And, you know, it's that challenge really for the Barclays investment bank is, can you basically do more with less?
Tom, as always, thank you so much for joining us. Tom Metcalf, they're in charge of our banking coverage with some great Bloomberg scoop this week. Now, we'll look ahead also to the Bank of England's rate decision. This is after the S&B was the first major central bank to cut interest rates. We'll look at BOE. We'll look back at Fed. This is Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Cycle in decades. Well, with us now to preview today's decision, Hannah Gooch-Peters, Global Equity Investment Analyst at Sanlam, and Dan Hansen, Bloomberg Economics Chief UK Economist. Now, I have a million questions about the S&P, which we'll get to on in a second, and gold. But then, you sat down, and I always actually tap Dan for information. I mean, I'm literally always emailing him saying, what do you think about this, and what do you think about that? Given the S&P, given what we heard from the Fed and even the BOJ, does Bank of England take that into account, or they just look domestically at what's happening and try not to mess it up?
Yeah, I mean, I think it's interesting, this one. I mean, obviously no one's expecting a move in terms of rates, but we've got 2 things that I think that are important for this decision. The first is the vote. So are those 2 policymakers that voted for hikes in February, is that hawkish dissent going to fade away? Because we've had some pretty good inflation data, we've had some pretty good wage data. The other thing to look at is the guidance. You know, we're still talking about restrictive for an extended period of time. That's the sort of turn of phrase that the bank uses. I think something that will be interesting to watch is whether they recognise the fact that by bringing rates down just a little bit, we'll still be in restrictive territory, and that's something Hugh Pill has mentioned in speeches. And I think that's somewhere, I don't think they'll do it today. I think it'll probably be in May, but I think that's somewhere to look and to watch to see if they're becoming sort of keener on the idea of bringing rates down a little bit.
But Dan, they seem to be less committed because of the complexities also of the UK economics. So they're less committed in terms of timeline than the ECB and the Fed. Again, is it because it's more complex or because they don't want to get it wrong?
I think it's because they got burnt last year really badly. So in February, if you remember back to February last year, they kind of signalled they were done at 4%, and they felt quite comfortable at that level. And then we had these two big surprises in the spring where inflation shot up. We ended up getting a late cycle 50 basis point hike in June. Then inflation surprised to the downside and they paused. So they're very much in this meeting by meeting approach. So I think they're very, and because you've just seen the PMI, the economy's not falling off a cliff, they've got time. So they're going to just hold out that little bit longer to be sure they're going to get it right and not sort of preside over a resurgence in inflation.
And Hannah, we've heard this for the last 6 months, right? Central banks in general are just saying to the markets, watch out, hold down, slow down, let's look at the data. And markets kind of running away with some kind of, narrative. What are you expecting from the BOE?
Well, I think that if you look at the UK equity market, it kind of says it all. So it's massively lagging the US market again this year. It's not really going anywhere, and I think that the only stocks that are really moving hard in the UK market are those ones that are those big international earners. So you've got your intercontinental hotels, you've got companies even like Sage in technology, small business accounting software technology, doing exceptionally well, and then you've got your UK domestic stocks again sort of lagging. So I think that the UK market is very much focused on companies that are able to grow their earnings outside of the UK, and the domestic story for the UK I just don't think is playing out very well.
But so what does that mean for how we look at the investment in asset classes? I mean, there's gilts. I keep on hearing that maybe this year is the time of the UK because we'll have a relatively boring UK election, and so compared to other places in the world, it'll be seen as a stability, beacon of stability even.
I think that if you're having challenges with things like higher rates and inflation, then you've got to focus on quality. So it's companies that are able to pass these pressures through to their end customers, and also that they're trading on reasonable valuations because of this higher rate environment, also higher bond yields. So I think it's just a story of selectivity, and this concept of narrowness that we're seeing in the US market isn't unique to the US market. You'll also see that very much in the UK market. You see it very much in the European market. So it's just about selectivity from here if you're trying to look forward to improving your return expectations the rest of the year. So focus on international companies that are leaders in what they do and have the ability and the durability of that earnings stream, I think, is really important this year.
So Hannah, is the US still the most attractive place with because of also what the BO data? Is Japan the same?
I think that the US just naturally has more higher quality companies available. So I think that it's a better fishing ground to go. But ultimately, I'm not really fussed about where companies are listed. These are all big international earners. But I think that the concentration you've seen in the US market in particular is really starting to offer up opportunities. This higher rate environment that on a headline level seems to be ignored by the US market. You've got the S&P up sort of going on 10% this year. It's very much driven by a few stocks. So underneath the surface, you are seeing the impact of higher rates on companies. You've got companies like the big health insurers are trading on valuation levels that haven't moved for 5 years. You've got companies like the exchanges, for example. These are fantastic high quality companies, but the valuations are actually looking very compelling versus the sort of headline level of the S&P. So I think just be willing to look underneath the surface, underneath those big constituents that are driving equity market returns, be that in the US, Europe or the UK.
Yeah, anything with debt? I mean, do you look at debt or some of the corporate bonds, certainly corporates? Because then I want to ask you about what you do with gilts and the kind of moves that we could see there.
Well, I think that if you're looking for real returns, I'm very much positive on the equity market. If you're wanting to beat inflation over the long term, and if you're wanting to, get away from this problem of a higher rate environment, I think on the impact of markets, I think that. Debt is very important in terms of balance sheet sort of quality for companies. So you don't want companies that have got a lot of debt on the balance sheet because you don't want to have to worry about how they're going to service that. So again, high quality, clean balance sheet, durable earnings growth, a reasonable valuation, I think is very much where you want to be placed in this environment.
John Authors has a really brilliant piece today, also looking at some of the dot plots in the U.S. and how they've moved. And again, he talks about the neutral rate, and maybe one of the most important things that we've heard instead of, the dot plots is basically some of, for example, the median estimates that they're expecting for neutral rates. When you look at how the UK could be reformed, so we have the Ben Bernanke review coming up. Is there anything? The BOE seems like it's in an okay place in terms of communications. Am I wrong?
Maybe. I'm
a little bit optimistic. Ilarian actually says that at least they've always been upfront.
They have. I think they could be more upfront, to be perfectly honest with you. One thing, and we've written a note about this, I think Bernanke could suggest is that they publish their rate, what they think is the best or the most likely path of interest rates going forward. So slightly different to the dot plot, where what they would do is use that interest rate path in the model and use that in their forecast. Because I think if you look back over past forecasts, at least recently, for example, in November 2022, when we had the mini budget meltdown, the bank put out forecasts of a very long protracted recession and massive undershooting inflation because rates were too high in the market, but it takes the market curve into its forecast. And so you're putting out forecasts that you just don't believe, essentially. So I think one thing he will very likely suggest is that they just basically come clean a bit more. And going back to that point I was making about moving meeting to meeting, putting something out there that tells you about the longer term path of interest rates, because that matters for mortgage rates, and obviously that matters for individuals, and it matters for the transmission of policy. So I think that would be a sort of important step and something he could potentially recommend.
All right, thank you both for joining us. Dan Hansen there from Bloomberg Economics and Hannah Gooch-Peters from Sanlam. Now, coming up, you're looking at live pictures from Brussels of EU Commission President Ursula von der Leyen, where EU leaders are gathering to discuss key issues in security, defense, and foreign policy. With support for Ukraine top of the agenda, we'll also bring you an exclusive conversation with the country's prime minister. That's next, and this is Bloomberg.
Readily available source of low-emission electricity. Extending the safe operation of today's nuclear fleet is one of the chief.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community. When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
So we have assurances from United States Senate because they approved this draft law. So now we are waiting decision of Congress. We have very active dialogue and negotiations with many congressmen from both parties. We have bilateral and bipartisan support from the Congress, and I believe that during the nearest time, this month or maximum next month, we will have this good news from United States, and United States will join to European Union, to G7 coalition, military and financial support of Ukraine in this battle with Russia.
The rhetoric changing here in Europe. We heard Emmanuel Macron, the president of France, talking about potentially boots on the ground in Ukraine. We hasten to add that that's not something that Ukraine has asked for, but do you take a message from that? Is there more urgency here in Europe? And also, would you welcome boots in Ukraine from Europe, even in non-combat capacities?
I should say that for the last 1.5 years, maybe 2 years of full-scale aggression, mindset of many European politicians is changed dramatically, and it's very good news for all of us because we understand that Russia is aggressor, is terrorist country, and Ukraine now is protecting European borders. So we are very glad that President Macron communication is much stronger. It's very concrete, very clear, and this is what we all need, not just Ukraine, but all European Union. We should be very concrete, very fast, very clear, because the only way to fight and to liberate in this full-scale war with aggression of terrorist country such as Russia.
Well, that was Ukraine's Prime Minister speaking exclusively to Bloomberg's Oliver Crook. Now, Ollie joins us now from Brussels, where EU leaders are meeting today to discuss key issues, including security, defense, and spending. Ollie, so center stage will, of course, be talks about freezing Russian assets. What are EU leaders saying?
Yeah, Francine, so really at the heart of this question here is how do you make the financing for Ukraine, put it on sustainable and durable footing? Because we're talking about tens of billions of dollars, and despite all of the goodwill that there is to Ukraine, when you're talking about those kinds of sums of money, things become complicated. Within the EU, and as we've seen within the Congress in the United States, where that aid package is still stuck. So the question is, where could that money come from? One of the answers that might solve that is these frozen Russian assets, of which there are about 260 billion euros worth within the G7, 200 of those sit here in Europe, and that throws off about 3 billion euros a year in terms of profits on those assets that the EU now wants to discuss about how to disperse that over to Ukraine. Now, you need consensus and you need a sort of majority, or not just a majority, you need unanimity from the member states in order to move forward with something like that. So it's very complicated. So they're trying to find ways in which there could be language which all member states could get behind. And we spoke to the Ukrainian Prime Minister about this issue. Have a listen.
Now, European Union have made first step, confiscation of revenue of these frozen Russian assets and usage this for Ukrainian needs, for urgent Ukrainian needs. And we believe that this is only the good sign and only the first step. And we continue discussion how legally and politically organize this confiscation of frozen Russian assets.
And at the end of his answer there, he's alluding to the fact of not just using the profits from the Russian frozen assets, but the underlying assets themselves, which obviously the Ukrainians would be in favor of. However, the United States is also in favor of this, and Biden and the administration want to make progress on the dialogue with Europe about this before a G7 summit in June, where they would potentially look at using those assets to fund the war. And again, there are 260 billion euros worth of them, so that would take it a very long time indeed.
So they'll also only discuss broader European defense. What will they talk about?
Yeah, so the question here is also another question of financing. So we had earlier from the EFO this week doing a sort of study on how much money is actually required for all of the European NATO states to reach their targets, to hit that 2%. How much money is that? It's 56 billion euros. How do you finance that? One of the questions is talking about the European Investment Bank. They want to change the rules there so that they can take the funds from there to lend to military application. Right now, it needs to be both civilian and military applications. They want to change the rules. There you seem to have some consensus. The 14 member states have have signed up to this. You just need a simple majority to change that. But that fund only has about 8 billion euros in it that can go to military. That leaves a huge gap. So this will then bring into the fore this big conversation, which is a much longer discussion, but we understand the French are keen to push it today, which is, again, this idea of joint debt to help finance boosting European military, which, as we know, is in a sort of very precarious state, particularly ahead of a U.S. election, which could bring certainly some new questions for NATO.
It certainly could. Ollie, thanks so much. Oliver Crook there live in Brussels for us. Now, coming up, it sounds like science fiction. A paralyzed man is able to control video games with the power of his mind. We explain after the break, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and radio. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Well, chess is often called a thinking game, but Neuralink is taking it to a whole new level. The brain chip company founded by Elon Musk has shown its first patient playing online chess and other video games using his mind. Well, Nolan Arbog is quadriplegic after a freak driving accident 8 years ago. He said the surgery was super easy and has changed his life. Now, the video also lifted Chinese stocks related to brain implant technology, with innovation medical management rising close to 4%. Let's discuss all of this with Bloomberg's Alex Webb. First of all, Alex, I mean, I was alerted to the fact that you have, China brain stocks, which I didn't really know was a thing, and I don't know how far away we are from this being developed much more widely.
Yeah, I think that's the crucial thing here, right? That ultimately, this technology in itself is not necessarily bleeding edge. There are a lot of people doing this sort of thing. I think there were some comments from academics saying, great, this is a good starting point, but ultimately this is something we knew was possible. The crucial thing here is about the industrialization, the commercialization of it. And this is clearly something that Elon Musk has pretty decent track record at doing. Not out and out successful with everything, but when you look at obviously SpaceX and Tesla, he's got a good track record at taking things that seem sometimes like kind of pie-in-the-sky ideas and commercializing them. He also has access to a huge amount of capital. So if he is able to, bring this somehow to market, it's nothing immediate, it would seem, there will be a lot of other companies riding on its tails.
Alex, what would it be used for? So again, I mean, this is a very specific case, and it helps people communicate and do things that otherwise they would not be able to. It's for science and for medical reasons.
Yeah, I think that's certainly the first sort of frontier on this stuff, right? It's the kind of the medical applications, people like the quadriplegic gentleman in this particular case. You can imagine a world where not only are they playing chess, but perhaps, steering a wheelchair, right, with this implant. I think in Elon Musk's world, he also would love to have a future where actually, everyone would have this sort of thing, or someone without a medical condition could have it in order to control parts of, say you have smart glasses, for instance, and you control what's going on there. But that is a very long way away.
Okay, Alex, thank you so much. It did really read like science fiction, certainly when we were looking at some of the images. Our Alex Webb there looking at technology. Now, Reddit has raised $748 million in an IPO priced at $34 a share. That's the top of the marketed range. To discuss the latest addition to the NYSE and other U.S. corporate stories, we're also joined by Bloomberg's Charlie Wells. Charlie, this is exciting. So we've been talking about Reddit for quite some time, but it goes public in just a few hours.
Yeah, so what I would say the theme of today for Reddit, at least at this point in the morning, just a few hours from this stock going public, is so far so good. And I mean that in so many senses of the term. I mean, they've come so far since 2005 when they were founded. They've come so far since 2021 when they initially filed for that IPO. And so far, things are looking good. They were able to price at that upper end of their range. But let's see what happens in just a few hours.
The other story is, of course, the U.S. Justice Department, we understand, is poised to, as soon as today, basically tell Apple that they're violating antitrust laws.
This is a striking escalation of the Biden administration's antitrust fights with big tech companies. So Apple is the latest to this list. The Department of Justice is already suing Google for monopolization. The FTC is going after Meta and Amazon as well. But this is striking because the DOJ has actually sued Apple 3 times in the past 14 years on antitrust violations. But this is the first time that they are saying that they illegally tried to maintain their dominance in the market.
Okay, and then the other story we're looking out for is, of course, Micron, and this is on better than expected forecasts.
It really is, and I mean, this kind of demonstrates the kind of Midas touch that AI is really having for a lot of different industries. And so Micron is the largest U.S. maker of memory chips, and if you'll recall, just a few months ago, there was a really big issue in the memory chip industry because of weak demand for smartphones, weak demand for laptops. And so look, memory gets used a lot in a lot of AI software, a lot of AI hardware needs this, and so this was a boost, and their shares were up 15% in late trading.
Okay, so interesting. Charlie, thanks so much. Charlie Wells there with the very latest on some of these U.S. companies that we're watching. Now, let's recap our main story of the morning. The Swiss National Bank cut its key interest rate by 25 basis points, acting months before global peers may follow suit as policymakers try to prevent gains in the franc. Now, you can see at the moment, Euro Swissy 95 or 97.552. Now, a little reminder that a little bit later this morning also we'll bring you an interview with the outgoing S&P president, that's Thomas Showdown, after the surprise rate hike. The picture across the board for markets is definitely left, right, and center what's been going on with central banks. Stocks still rallying actually to all-time highs. Tech and commodity stocks really leading the charge in Europe, but also it's probably leading some of the gains in the NASDAQ and the S&P futures. Traders in general, not only in the U.S., but also in Europe, growing more confident on the path for lower interest rates. Now, equity market optimism has really been reignited after the Federal Reserve policymakers kept their outlook for 3 cuts this year, despite this recent rebound in price pressures. The chair, Jay Powell, continued to highlight officials would like to see more evidence that actually prices are coming down. He also said it will be appropriate to start easing at some point this year. I'm looking at treasuries steady, the dollar posting smaller moves. I'm looking at Brent trading above $86 a barrel, Bitcoin holding on to 67,000. This is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Policy rate is likely at its peak for this tightening cycle. It will likely be appropriate to begin dialing back policy restraint at some point this year.
I think this is a signal, and the market is taking it as that they will tolerate slightly higher inflation for longer.
So yes, they have to tolerate a little higher inflation in the near term, but I don't think they're giving up on that 2% goal.
I think this is a Fed that really wants that soft landing to continue.
So we still think we're going to cut rates this year. Timing's uncertain, and he said over and over again, it depends on the data.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Well, that was fun. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance, your equity market on the S&P 500. Record highs at a close yesterday. We had some weight to that rally this morning, up 1/3%. The biggest takeaway of the last 24 hours following Chairman Powell's news conference. Citi's Andrew Honenhorst. Here's the quote, Lisa. Stronger inflation won't stop rate cuts.
This is a Federal Reserve that wants to cut rates, and the recent hotter-than-expected inflation data has not stirred them from that path, and that really is the message that the market is hearing loud and clear.
Two developments for me in the market, and you can take your pick on what stands out for you, but two for me. Equity markets all-time highs at a close yesterday on the S&P 500. Seen a few of those. Gold through 2,200 for the first time ever. What do you think gold is picking up on following yesterday?
Either it's an inflation hedge, which is what people are looking for, or it's been sort of a steady march higher. And this raises this question, the end of tight monetary policy, if you can call it that, a lot of people do,
tight monetary policy means that real assets have more value again, given that interest-bearing assets aren't going to be as interest-bearing going forward.
The inflation trade just creeping back in just a little bit more in the last day or so. Lisa, we had some questions for the Federal Reserve Chairman. Has he gained confidence? Has he lost confidence following those hot CPI and PPI prints in the last couple of weeks? The answer to that was basically neither. Basically neither, unchanged. He referred to them as bumps, basically looked through the recent inflation data as bumps in the road and said almost explicitly the story hasn't changed.
Ultimately, this was a Federal Reserve that had some changes and didn't explain any of them. He said a lot of words, but didn't really have a different message, and frankly, didn't even have a cohesive story to tell, other than we're making progress, we're going to be patient. And you know what? If it takes time to get down to 2%, we're okay with that because it will get down there. And to me, this is really the ultimate sort of turbocharger to stocks. This is a Federal Reserve that will prioritize a soft landing over inflation data that is bumpy, that is causing some agita in certain corners.
So the bumpy road to 2%, let's talk about that commitment to 2%. This is just one example of maybe accepting slightly higher inflation. But if you go through the forecast, we had a big upgrade to GDP, a slightly less as big upgrade to inflation. Now, they can make the argument that maybe on this occasion strong growth isn't the problem, but if you repeat that in June, then we've got much, much bigger questions about their commitment to getting back down to 2%. I think they can have a one-off excuse this time around. I don't think you can repeat that in quite the same way in a few months' time.
Which is the reason why there still are the no rate cut people out there who are saying they want to cut rates, but they're not going to be given the privilege to do so. And this is really ultimately the question of when do the data points become more than noise? And right now, it seems like the Fed is dismissing them as noise. The market, maybe not, but they're taking the message loud and clear that the Fed isn't going to take it seriously until we get some more months. And this is the reason why data dependency is so difficult. It's like, how many data points do you need to be dependent on those data?
Do you want some rate cuts? Head to Zurich, Switzerland. Surprise 25 basis point cut. Much weaker Swiss franc overnight. Dollar Swiss pushing 90 now on my screen, that currency pair breaking out by about 0.8%. So I know I refer to them as second-tier central banks, the likes of the S&B, the BOE, but you're getting a flavour for what other central banks are doing this morning.
They're trying to get ahead of any move from the Federal Reserve or the ECB because they want a weaker currency. They want a weaker Swiss franc. And to me, this really raises the question, will the second half of 2024 be the race to cut? Essentially, how do you cut first and get ahead of the others so that you can carry the benefits a little bit of being a market leader and, frankly, edify an economy that otherwise could be beset by fears of a hard landing?
We've got a lot to work through this morning, so let's get to it. Equity futures on the S&P 500 positive here by 0.3%. The equity market doing better than okay. Yields down again by another 4 basis points on a 10-year, 4.2275, and a euro just about unchanged against the dollar, 109.17. Coming up this hour, Chris Strategas as the Fed fuels stocks to fresh all-time highs. Bloomberg's Craig Trudell as the Biden administration relaxes EV rules, making some room for hybrids. And Ian Steely of JP Morgan on the Fed's path forward. And if the call for 3 cuts this year will shift to 2 or even fewer. We begin with our top story. The Fed fueling global stocks to all-time highs. Fed Chair Jay Powell and company sticking to 3 cuts for the year despite a string of hotter-than-expected inflation prints. Small caps posting their best day in a month with gold running above 2,200 for the first time ever. Chris Strategas, a Baird company, joins us now for more. Chris, buddy, let's get to it. Gold. What is that breakout in gold all about? Going through 2,200 for the first time ever.
I mean, John, when you look back at the sequence of events the last several weeks, let's first go back to January, February, when you had that decisive move in gold through 2,100. And then what we found really notable these last 2 weeks, as bond yields pushed back higher, right? You had yields go from 4 back to about 435. Gold didn't flinch. It was a very orderly pause. The title of our client note this morning is Gold knew, right? Gold knew we were going to get that we were going to get a dovish Fed yesterday, and I think certainly the response speaks to that here. I think the backdrop here remains very bullish gold. It remains bullish metals. It remains bullish materials. We see that with the expansion in new highs in things like copper, Freeport-McMoRan, the material stocks, etc.
Chris, watch what they do and not what they say. When you look at what they're actually doing, not what we were told in the news conference, is that a Fed that's signaling they're going to tolerate higher inflation?
Well, I think when you look at the tone of really global bond markets over the last couple months, I think the bond market is set on the idea almost regardless of where some of the near-term inflation data comes out, these are global central banks that are going to cut. I mean, we see the move in Swiss overnight. The Swiss bond market's been telegraphing this for weeks and weeks and weeks. The Swiss currency's been telegraphing this. I think when you look at things like UK 10-year yields, they've rolled right back over. German 10s are still below the 200-day. So the global picture from bonds, I think, supports the idea that almost irrespective of where the future inflation data comes in from here, you will get central banks cutting this year.
Just to put a bow on the idea of why there is so much demand for the likes of gold and some of the metals that you're talking about, is this a trade on the idea that maybe inflation is going to run hotter in the future and this is a good hedge against that? Or is this a trade that a Fed and the rest of the central banking complex cutting rates will support growth and some of the demand for these assets?
I think it's a little bit more of the latter, Lisa. We've used this term fiscal dominance to describe why we think gold is in this bull market, which basically implies the central banks have to ease given the position that the sovereigns are in really across the world. Now, anytime you see gold break out, your mind does begin to wander. Is there something sinister or something ominous on the horizon? I think if gold was trying to communicate to us that there's something nasty out there, we would also see it in credit conditions deteriorating, which we have not seen yet. We would see it in weakness in financial sector stocks, which we certainly have not seen. Yesterday was one of the best new high readings in the financial sector that we've seen in months and months and months. So I think gold is more about the position the central banks are in relative to where their fiscal counterparts are, as opposed to some real ominous message about economic growth down the line.
Given that, it's understandable why there's so much momentum and so much money just flooding into the trades that have done best so far this year. At what point do we have to worry about the fact that we have an economy that's being turbocharged by fiscal money and a Federal Reserve and other central banks that are poised to ease monetary conditions to the tightest levels in decades at a time where we're not seeing those real signs of weakness that could potentially curtail any upside surprise?
Well, it's funny, Lisa, we always talk about or kind of make light of everyone has all these fancy liquidity models. I mean, the only liquidity model anyone needs is the price of gold or the price of Bitcoin. And I think that tells you everything you need to know about the liquidity environment that we continue to deal in here. Now, what's been a little bit ironic is despite this just ripping move higher in gold, the paper market, the flows have basically been non-existent. The flows into the GLD are very, very modest, certainly compared to where we have seen gold top out in the past. So I don't think sentiment is that huge threat yet. Your question also alludes, I think, to a longer-term idea of at some point, does growth ultimately begin to slow? I think if that's the case, we're going to see it in a change in equity market leadership. I would expect to see things like industrials deteriorate. I would expect to see consumer discretionary begin to weaken versus consumer staples. There's just not a ton of evidence of that yet. So for lack of a better term, we still very much seem to be in this sweet spot where you have bond yields that likely don't run away from us, dollar that doesn't run away from us, and I think gold and copper and discretionary and industrials all reflect that.
Chris, let's talk about leadership in the equity market. Usual suspects yesterday, top of the pile, discretionary, communication services. Energy actually lagged. You see any signals that maybe energy can take the baton from big tech?
Well, I think there's a couple of important things going on, and you mentioned energy and materials. I wouldn't call them leadership, but John, they're not going down. And when your laggards are at least going up in price, it describes a pretty full environment where there's lots of participation. I mean, we're still sitting here 3.5 months into the year, and 80+% of the S&P is above the 200-day moving average. So it's still pretty broad by almost any metric. Now, something we always like to do in our work is look at what the consensus perceives to be the weakest group and then simply ask, is it behaving as if it's the weakest group? And I still think just from our meetings and our conversations, the consensus believes that commercial real estate and regional banks will be the source of any new stress or trouble. But when you look at the charts, they're just not that bad. The bank stocks are still pretty well bid here. The regionals certainly moved yesterday. The REITs, frankly, trade pretty well, or certainly trade along the idea that you will not get bond yields running away from you here. And I think that's the big key. Like our thinking, our approach certainly would have to change with 10-year yields above 450. That's just not our base case here.
So are you a screaming bull, Chris?
I'm certainly bullish. We've been bullish. We remain bullish. I think the changes to that If there's a problem that's brewing out there, if there's something sinister, I think it's too early to know. And I think importantly, Lisa, we would see it in really degradation or deterioration to the leadership fabric of this market. And that's largely been intact for the last year. I focus on things like, is discretionary still outperforming staples? Are industrials continuing to set the leadership tone of this market? I think so long as those boxes are checked, we're in this status quo environment. Now, you always have to be on guard for things that could change your view or upset that. Maybe it's oil to 90, maybe it's rates to 450, but neither are our base case here.
Hey, Chris, got to catch up. Chris Ferrone, a strategist. For so many, that was just a green light in that news conference to buy equities and buy pretty much everything. Bonds rallying as well, gold rallying too, everything rallying against the US dollar in foreign exchange as well. Let's give you a snapshot of some of the feedback that we've got on the south side. Pantheon Macro, recent inflation data, just a bump. Capital Economics, Fed still on track for a June rate cut. I mentioned Citi earlier, worth repeating. Rate cuts are coming even if inflation or growth runs stronger than expected. We were trying to work out how would the recent data change the story at the Fed. Hasn't changed it at all. In fact, Chairman Powell said a few times in that news conference, story hasn't changed.
Which raises the question, at what point do inflation concerns become a threat again? Or does the market buy into the idea that the Fed does, that growth is not going to cause inflation to materially increase, that it actually is compatible to see inflation come down, even with strong growth that could potentially even reaccelerate, especially given some of the optimism that we're hearing from everyone across the board?
That's a conversation we need to have a little bit later this morning and throughout today. Equity futures right now positive by a third of 1%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Swiss National Bank cut its key interest rate by 25 basis points, acting months ahead of the Fed and ECB. Officials lowering their benchmark rate to 1.5%. Some investors were betting on a cut, but most economists predicted the rate would stay unchanged until at least June. The franc tumbling after the decision, falling 1% against the euro to its weakest level since July 2023. Job cuts are coming at Barclays. Bloomberg has learned the UK bank is preparing to cut several hundred jobs within its investment bank. The move comes as the firm embarks on a years-long effort to trim costs and boost profits within the unit. Astera Labs surged in its trading debut, marking the best first-day gain for a U.S. IPO since 2021. Shares of the semiconductor connectivity company rose more than 70%, giving the company a market value of almost $9.5 billion and adding momentum to the AI stock frenzy. The listing is the fourth largest in the U.S. this year, according to data compiled by Bloomberg. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, relaxing the rules for EVs.
When you look at this, the consumer is pushing in the direction of hybrid. As we look at this in the near term, we're going to see hybrids continue to gain in popularity. EVs are stagnating. So I think we're going to see, a market that gets, heads towards hybrids.
The latest on policy down in the nation's capital. Up next from New York City. Good morning.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
The rally continues. If you're just tuning in, up another third of 1% on the S&P 500, following an all-time high at the close yesterday. We called it the everything rally, a rally in the bond market too. We are lower again in yield, down almost 5 basis points. The 10-year 4.2255. Under surveillance this morning, relaxing the rules for EVs.
It's a major part of the economy. In the U.S., it's 4% of GDP. It's a larger portion of your employment base. When you get into the secondary market, it's twice that. So if you were trying to drive and support an economy, this is really where you start. When you look at this, the consumer is pushing in the direction of hybrid. As we look at this in the near term, we're going to see hybrids continue to gain in popularity. EVs are stagnating. So I think we're going to see, a market that gets, heads towards hybrids.
Here's the latest this morning. The Biden administration easing planned regulations on the auto sector, making room for hybrids in the push for more electric vehicles. The new rule also giving automakers more time to comply with stricter emission standards before the year 2032, after warnings from industry and Labour leaders. Craig Trudell of Bloomberg joins us now out of London. Craig, this feels like a win for the traditional automakers who are maybe considering leaning into hybrids a little bit more.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly. We're Monzo. Give us a go.
See? I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
But, the threat that this poses to folks who work at engine and transmission, combustion assembly lines across the U.S. And we talk a lot about, the idea that electric vehicles have fewer moving parts, less, things to put together. A huge part of what, is potentially disruptive here is, some of these less paid attention to factories that do, some of the powertrains as opposed to putting the end vehicles together.
You raise an interesting point. How much of the rhetoric, and we're hearing a lot of it around the auto industry right now, how much of it is just purely driven toward the election and will die out, along with all of the proposals, whether it's some of the changes to this administration's approach or whether it's Trump's talk about maybe 100% tariffs on Chinese-made vehicles coming in from Mexico? Is this just talk to get ahead of the election?
Well, it was really interesting to hear, some of this rhetoric out of Trump, because the numbers that he's thrown around have been sort of all over the place in terms of what exactly he's going to do tariff-wise. But I think, generally we're going to hear more and more of this, rhetoric about the threat that Biden's efforts to electrify the industry poses, because there is, some validity to this idea that this is going to be a disruptive force. And so, even as workers maybe are willing to hear Biden say that he's looking out for them, there is a real concern about, just how much there's a sort of willingness to change, because this is an industry where, a lot of the folks who have worked on these assembly lines and in these factories have done so for decades. And so if you're going to fundamentally change this industry, that's, requiring a leap of faith. And I think you're seeing Trump sort of seize on that willingness to sort of second guess what Biden is talking about. And yet this is, something that Biden can point to as a real sort of achievement in terms of, what the IRA has accomplished, how much investment it's attracted.
Greg, I'm thinking of Detroit this morning. So they've got clarity on policy now in Washington. They can really start to plan. Mary Barra, as you know, at General Motors was starting to consider going back to hybrids, something they've been reluctant to do because they really wanted to go all in on EVs. What do you think the next move is from some of these automakers?
I think it's going to be the case that, generally combustion only is just not going to cut it anymore. I think in order to come anywhere close to where these sort of rules are requiring, you need to at least partially electrify virtually everything. And so, whether that means, slowing down some of the, fully electric move, I think we're absolutely seeing that in terms of, getting cold feet about, just how ready the consumer is to go fully electric. That may be the case, but you can offer conventional hybrids that don't even have a plug, and you don't have to worry about sort of bringing the consumer along, even to whether or not they install, a plug in their garage. Even just, going in the direction of partially electrifying combustion engines will go a long way to, reducing the emissions of the fleet and, getting the consumer used to this idea that there's also, by the way, reasons that this, can improve the performance of your car. If you get a little bit of extra oomph off the line, that may sort of open the eyes of the consumer of, what, maybe this isn't so bad after all.
I tried to get some detail out of GM. Craig, I struggled too, and I wonder if you know where this is going. How easy is it just to transition on the factory line to start making hybrids?
I think I listened to your interview with Mary Barra a few weeks back, and she was a little bit cagey about this. It is not going to be, snap your fingers and these plants shift over to hybrids. This is going to be something that's going to play out, probably going to take GM a good year or year and a half before we start to see, some of this decision that they've made just in the last few months to really sort of come to fruition, and for us to see this, end product of more hybrids available at your dealership.
It's a notable shift. Craig, appreciate your time. Craig Trudeau there out of London on the latest from the EPA. In many ways, and let's start with the administration, attempting to speak out of both sides of their mouths, I guess, because on the one hand, they want to speak to climate activists. We're going hard. We're going to be tough. On the other hand, they want to give concessions to union workers, auto workers in Detroit to say we're not going as hard, you can do other things as well.
Which means that ultimately, are we looking at a policy that's shifted, or are we looking at rhetoric that's shifted ahead of an election, right? If we hear what Craig is talking about, what a lot of the auto manufacturers are talking about, the fact that these rules were altered based on some of the feedback from the auto manufacturers in the United States, it feels like this is a slight shift. The focus is now more on emissions. It's less on electric vehicle subsidies in the same kind of way. And to me, there will be history books written about whether this sort of indicates the end of an era in a way, and some of the hopes and dreams of that particular.
Possibly. It's not about what you think, it's not about what I think. Ultimately, and you've said this, and I think you were dead on when you did, this is where the market is. The market has spoken, and they've had to listen. Otherwise, you're going to get automakers in Detroit in a big, big mess. Equity futures right now on the S&P, positive by a third of 1%. Live from New York, this is Bloomberg.
was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What a move yesterday in the equity market. Green light, buy stocks. Chairman Powell. Equity futures now adding some more weight to that rally. Up by another 1/3% on the NASDAQ, up by 0.7. Small caps outperforming yesterday big time. The Russell, biggest day of gains in about a month. Up again this morning by 0.6%. In the bond market, let's turn to fixed income. Starting the week through 470 on a 2-year. Down another 4 basis points now, 455.97. Lisa, that's quite a turnaround over the last 4 days.
If you take a look at Fed funds futures, traders are now pricing in about a 70% chance of a June rate cut. That is up from 57% chance the day before the press conference. This is Jay Powell doing greatest hits of dovish knocks, basically saying, we're going to cut rates. So stop it with thinking that this is somehow going to change the whole picture. The market got the message loud and clear, and it's off to the races.
You know what TK would say? That's a great band name. What was that? Dovish hits after hawkish knocks.
Well, it's a lineup. It's a band lineup, which is essentially what we saw yesterday.
This is a very different Fed chair compared to the one that we heard in August 2022. Completely different.
To me, I was really thinking a lot about this last night with the little capacity that I had left to think. There was this question of, are we looking at a time where you have fiscal stimulus that's coming in with still full force, and then you've got monetary stimulus that on the edges starts to come back to the fore? What happens to the fight between these two? They're in sync, which raises this question. I mean, yeah, it's a green light to stocks. Yeah, it's a green light for risk assets. There's a question of, is there a consequence? Or is this just a golden era of incredible growth and incredible stimulus?
The consequence yesterday was a weaker dollar. There were many other consequences as well. Let's turn to foreign exchange and look at what's happening at the moment. We've got a surprise move from Switzerland. In Zurich, the SNB, Swiss National Bank, cutting interest rates, going against consensus. So what do you have? A weaker Swiss franc. Dollar Swiss, Lisa, out by about 0.7%. Later on this morning, I think about 90 minutes away, we'll hear from the BOE. It's the BOE's turn a little bit later. What interests me about the Bank of England is the vote. There are a couple of members of the MPC putting their hand up and saying, I think we should hike interest rates. I wonder if the recent data just clips the wings of the hawks at the Bank of England.
Everybody wants to cut, and everyone's a dove, right? Do we end up with a unanimous vote, at least, that the goal is down? It isn't necessarily up, because that was sort of one of the tensions at the Bank of England. Swiss National Bank, very different picture than the Bank of England, because they're looking at a different growth backdrop and a different kind of dominance of their currency. They want a weaker currency. For the Bank of England, it's this delicate dance, especially as they try to deal with a deficit and growth that's still sluggish.
SocGen, note just dropped in my inbox, title, Flock of Doves. Flock of Doves, which is kind of what it feels like in the last day or so.
Another band.
I know. Under surveillance this morning, Fed Chair Jay Powell staying on message, fueling a rally in stocks and bonds, insisting that tolerance for inflation has not shifted.
But it doesn't mean that. What it means is that we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down.
That came right at the beginning of the news conference, and I think those comments are so important. Going into that press conference, there was a clear and we thought obvious contradiction in the forecast for 2024. And if you go through the summary of economic projections and just look through the median projections, so growth comes up by quite a lot, unemployment comes down, CPI revised higher by just a little bit. And then you're looking at the median dot and you're basically saying, well, the median dot's unchanged, even though growth is going to be stronger and inflation is going to be a little bit higher than they're projecting. So it raised the obvious question for both of us. Are they willing to tolerate higher inflation? What gives? What gives? And then you get that response there. And he refers to inflation, and you and I were talking about it as the press conference was ongoing. It was a little bit higher as a separate matter, distinct from what's happening with economic growth. And I think he made that point repeatedly in different ways in the news conference as well. Stronger growth is not something that we're concerned about at the Federal Reserve. And we heard the same message at the end of January. It's on repeat at this meeting too.
And to me, I sort of shrugged it off as sort of, well, maybe he's just trying to hem and haw and get around the fact that it's not some sort of cohesive message from Fed members. It's each one of them coming up with their own guidelines. Rick Reeder, though, of BlackRock, had a really interesting point, which is essentially that inflation has not been a function of Fed policy on the way up or on the way down, and that essentially this is completely independent, and that some of the interest rate sensitive areas of the market aren't really fueling a lot of the inflation. And so the Fed's kind of impotent. And what they're trying to do is gauge how to not become part of a problem as some of these other areas right-size, which really raises a question, has the Fed lost control over the inflation narrative entirely, which is the reason why maybe stock markets have kind of moved on.
Did they ever have control? So
Correct.
Rick's colleague, Jeff Rosenberg, joined the program. If you missed Jeff, it was absolutely fantastic. When you asked the Federal Reserve and this chairman, can you give us evidence of how we are sufficiently restrictive? He'll point to the labour market. You ask economists about the labour market and the loosening, the easing that we've seen there, the cooling, they'll point to the supply side of the labour market. They won't even mention what's happening with demand because it's not about interest rates, it's about immigration, which is what we've heard repeatedly from economists on Wall Street.
Which is the reason why it's been so difficult to get the cycle right. And it's so difficult to come up with something cohesive and understandable, frankly, to say. I mean, it's mind-spinning, right? This from Rick Reeder. We find ourselves with a policy interest rate structure that in some ways is inefficient, slowing some segments of the economy quite a bit with high rates while appearing quite ineffective in reducing activity or price gains in many of the services segments of the economy. This is essentially where we're stuck. If the Fed is ineffective, essentially, are they basically saying we don't want to slow things materially on the other side? And then what's going to offset the other part? Is it going to be immigration? Is it going to be supply side responses? It's saying, over to you, government.
Overwhelmingly dovish, I think, without a doubt. I finished the news conference yesterday, and as we wrapped it up, I think we both said, the equity market bulls would just like to hear that news conference on and on and on. And if you're tuning in this morning, maybe you just want us to replay the whole thing. Instead of doing this program, we'll just replay the news conference for 60 minutes back to back for the next 3 hours. And equities can keep climbing higher. We're not going to do that. We're going to talk about another name. We're going to talk about Apple. The Department of Justice is set to sue Apple as soon as today for alleged antitrust violations. Bloomberg reported the DOJ will accuse the world's second most valuable tech company of blocking rivals from accessing hardware and software features on the iPhone. This would be in addition to the Biden administration's other antitrust suits against big tech. The DOJ has a lawsuit against Alphabet accusing Google of monopolization, and the FTC is pursuing action against Meta and Amazon as well. They are not in a good spot, Apple, negative 7% year to date.
Which is, again, kind of interesting given the fact that this government has been quite keen on the antitrust efforts. I will just note, though, people looking for some sort of different antitrust approach with a change in administration, this DOJ case was opened in 2019 under the former President Trump. We're looking at either candidate continuing with this antitrust type of action, which is compelling to me, given that a lot of people are saying it's sort of polarizing who to win.
It's such a good point, just how much distance is there between these two leaders at the moment going into this election later this year. Let's turn to foreign policy. U.S. National Security Advisor Jake Sullivan making a surprise trip to Ukraine, looking to assure allies aid will be delivered for the country's defense against Russia. Sullivan saying, quote, "We will get a strong bipartisan vote in the House for an assistance package to Ukraine. I don't think we need to speak today about a plan B." But Speaker Johnson has refused to act on a $95 billion aid package passed by the Senate, which includes support for Ukraine, Israel, and Taiwan. Leslie Vinjamuri of Chatham House joins us now for more, just as leaders start to regroup in Europe and talk about what to do next. Leslie, let's get to that. Can you explain to us, just frame, how much distance is there between Macron and everybody else?
Well, I think there is a divide, and Macron's really pushing forward, setting France out as a leader, saying that the possibility of Western troops in Ukraine is not unthinkable, and really at this meeting, doubling down on how does Europe work together to increase basically its rearmament, and how does it, finance that? That I think is the big question here. But I do think, as you've suggested, France is and certainly distinct in its views from Germany, from the UK, and even from the US. But there are others in Europe, Poland, and those Baltic states closer to Russia, who share this view. And interestingly, some leading commentators, Fareed Zakaria, came out recently with an op-ed saying similar, that the worst thing would be for Putin to win, and Western troops of some form on the ground should not be unthinkable. So there is momentum. And the backdrop to all of this is, of course, that ongoing fear that America will not deliver the amount of money that's necessary to really continue to sustain that support for Ukraine, even under Biden's leadership, and something that could, of course, change quite dramatically were Trump to be elected. I do think what we're hearing now is that supplemental bill that that the Speaker of the House will allow that to go forward, and there will be funding. But that is not reassurance for very long, that it won't be enough, and Europe knows that it needs to step up.
And just to sort of sit on that existential concept that the Euro region is facing, how much discussion is there of the ways to finance this, akin to what Emmanuel Macron was talking about with war bonds and things of this nature? Because this is really the key struggle. How do you pay for supporting Ukraine by Europe while also investing in some of the military strength, the heft, that the former President Trump is asking for, and frankly, they feel like they'll need, especially without necessarily being able to rely on the U.S.?
Yeah, I think there are two things here. One is there's an urgent question about how Europe contributes to defending Ukraine and getting those armaments there, and how they pay for them. And then there is the longer term question, which speaks to the pressure from the former president, but quite frankly, from multiple U.S. presidents, and one that will be sustained regardless of who's elected. But on the question of bonds, that will be very controversial. It strikes me that it's unlikely to move forward quickly. There is the broader question of using Russia's central bank frozen assets. That, I think, is getting a lot of traction. But this question of financing the support for armaments is critical at a time when European economies are, of course, not strong on the whole. So this meeting today is very important. And once again, Macron is an outlier and really setting forth a bold vision that many people are concerned about.
Leslie, can we talk about those frozen assets? They've been on the table for quite a while. I'm just wondering, what is holding that up? Is there a specific obstacle, a legal issue, a specific country, perhaps in Europe, that's doing so? Where is the holdup coming from?
I think that many people see this as breaking a fundamental norm. There's been, a shift in opinion. The debate has been going on for a very long time. The opinion has shifted, I think, in favor. And there is a question of exactly what are those assets used to finance, and that's a line that many people draw in different places. Some don't think it should be used to finance the direct purchase of armaments. Some have wanted to focus it primarily on the day after on Ukrainian reconstruction. But of course, that day after, you only get there by changing the balance of power on the ground and getting to some sort of peace. And so there is, once again, a question of urgency. But there is a legal and a normative position that divides many people across Europe and in the United States.
Yeah, in a big way. Leslie, thank you. Leslie Vinja-Murray there of Chatham House. It's difficult. A lot of this money, a lot of those assets are in some European countries. I think one is Belgium and the other is France. And what you have, Lisa, is how do you confiscate assets from a country you're not in direct conflict with? And that's the conversation that we've been having now for quite a while.
And how do you then move forward with having confidence put out there in the marketplace that you're a sort of loyal steward of the money that you've been given to hold custody of? It's a difficult moment. And this is something that we keep talking about, which is how do countries lose the ability to act with impunity, right? Like, how long can their sort of historical power get them through an era where they're changing the rules in real time?
What kind of precedent are you about to set? Equity futures right now on the S&P 500 positive by 0.3%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hakes. Hey, Yahara.
Hi, John. The U.S. is pushing for an immediate ceasefire in Gaza tied to the release of hostages held by Hamas. Speaking in Saudi Arabia, Secretary of State Antony Blinken says the U.S. is circulating a draft resolution at the UN Security Council calling for a temporary pause in the war. This marking a change. Until now, the U.S. had used its veto power at the UN to block calls for a ceasefire. This is Blinken's 6th trip to the Middle East since the Israel-Hamas war broke out on October 7th. Reddit will begin trading today. The social media platform priced its IPO at the top of its expected range at $34 a share. The offering values the company at almost $6.5 billion. Shares will trade under the ticker RDDT on the New York Stock Exchange. Bloomberg Technology will have an interview with Reddit COO Jen Wong live at 11:45 Eastern. The LA Dodgers firing the interpreter for superstar player Shohei Ohtani. ESPN reporting the player's longtime friend and interpreter Ippei Mizuhara racked up debts to a Southern California bookmaking operation, which is under federal scrutiny. Questions were raised after at least $4.5 million in wire transfers were sent from the baseball player's bank account to a bookmaker. Ohtani signed a record 10-year, $700 million contract with the team last year. That's your Bloomberg Brief. John?
Yahara, thank you. That story's insane. That's nuts.
Especially because he allowed, what, a $4.5 million transfer for his funds? And you know that the Dodgers are going to say, like, oh, it doesn't matter, just get out.
You know you've got a lot of money when like $4.5 million is kind of a round and goer, right?
I can relate.
It's like small change. Oh, totally, of course. Up next on this program, the Fed staying on message.
Powell's basic message is that the underlying story hasn't changed. We didn't completely buy into how good the inflation numbers were in the second half of next year. We're not completely put off by the bad inflation readings in January and February.
That conversation coming up next, live from New York City. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
This is Bloomberg.
Record high at the close yesterday, added some weight to it this morning. Good morning to you all and welcome to the program. Up a third of 1% on the S&P 500. Yields a little bit lower again, down another 4 basis points, 423.34 on a 10-year. Euro not doing much, 109.19. Under surveillance this morning, the Fed staying on message.
Powell's basic message is that the underlying story hasn't changed. We didn't completely buy into how good the inflation numbers were in the second half of next year. We're not completely put off by the bad inflation readings in January and February. We still think monetary policy is tight. We still think we're going to get more confident about getting inflation down to 2%. And so we still think we're going to cut rates this year. Timing's uncertain.
Here's the latest this morning. The post-Fed rally continues after the central bank reiterated its outlook for 3 rate cuts this year. Ian Staley of JP Morgan Asset Management writing, quote, "This is a Fed that wants to cut rates. There is still time before the June meeting for the data to fall into place, although the narrative has definitely been challenged." Ian Staley with us here in New York. Ian, good morning to you.
Good morning.
The chairman says he's committed to getting inflation back down to 2%. Do those projections look like they're committed to getting inflation back down to 2%?
I think he's more committed to keeping the US economy moving forward. I think he's indicated that probably happy to tolerate a little bit higher inflation and making sure that we do keep this soft landing in place. I think that seems to be his main goal. I don't think I've heard anything particularly different from what he said in December.
If that's the big takeaway for you, despite the fact that data has changed somewhat, what does that tell you that you should do in markets right now?
It tells me the everything rally is likely to continue for a little bit longer. It tells me that people want to be invested. It tells me that stock markets are going to do what they've been doing over the last 24 hours. And it tells me that ultimately investing in the fixed income market also makes sense.
So basically, Powell came up there and said, here's your cake. Here's a fork, you can eat it as well. And there's a question of how long can this go on before there is some consequence on the other side, maybe a stomach ache, indigestion, weight gain issues, whatever the case may be, because at a certain point, you have to think about, does this allow inflation to run hotter and then maybe make longer-term bond, the proposition for longer-term bonds less attractive?
I think what we heard is that they do believe they've got inflation coming down under control. Maybe the last couple of months have been a bit of a blip. They've said they're willing to look through that and see that the downward trajectory is still there. I think they generally believe they're in very restrictive territory, and they don't think they're taking themselves into easy territory. They think they're just effectively taking the foot off the accelerator of tightening to allow the economy to continue to grow. I think the first few rate cuts that we see are going to be driven by inflation. If we want to see a really serious rate cutting cycle that we've seen through other cycles, it's then going to be a deterioration in growth, and we're not seeing that at the moment. So I think that's what we're hearing, is we're going to have a few rate cuts unless things get a lot worse.
Do markets agree that they're in very restrictive territory?
When you look at financial conditions, no. But also those financial conditions are expecting the Fed to be easing off a bit. So we have to remember that there is still a lot of cuts priced into the system, which is what the market likes at the moment.
At what point does it stop? Or do you just sort of pile in? I mean, why not, and I joked about this, lever up and just pile into risk, because basically you're getting a green light not only from the Fed, but also from fiscal governments that are continuing to spend.
I do still think we've had a lot of tightening, and I don't think the lags have been as quick as maybe we've had through previous cycles. I still think there are concerns that those lags are going to come down the road at some point. So I don't think you want to be indiscriminate. I do still think you want to roll up your sleeves and make sure you're in the right corporations. But it does feel like the central banks are willing to just continue this rally for the time being.
Are we pretending they have control over something they don't have control over? Is that just one big game they're all playing in the media and financial markets? The Federal Reserve says we're sufficiently restrictive, and we're like, yeah, they are. Look at the labour market. Then when we look at the labour market and you speak to economists as to what's actually happening in the labour market, they point to the supply side as the reason to why things have cooled down a little bit, not the demand side. What do you think the Fed actually has control over when we sit here and, I'm going to say, pretend we are sufficiently restrictive? What do you think they have control over?
I think, no, so definitely supply side has driven growth. I think that's why inflation is coming down. When we look at the employment picture, it went from a very, very hot period. It is slowing. It is cooling down. We're seeing a slowing in wage growth. We're seeing a pickup in quits. Sorry, a reduction in quits. We're seeing a reduction in openings. Things are heading in that direction. They're just heading slowly. And I think the central banks are looking at it. They're looking at what growth is happening to growth, and they're thinking we can keep this going. We can maintain this if we're sort of cute around how we deal with this, and some rate cuts will help that.
So June is the call for you. If the data falls into place, can you explain to us what the data falling into place actually looks like? What is that? Is it 2.5% PCE? I don't even know anymore. What is it?
I think you've got to start seeing 0.2s and 0.3s on a monthly basis on the core PCE. If we start seeing a whole list of 0.4s, I think that is going to call that into question. But I also think in a mindset where the central banks, they do, like Jay Powell, he wants to ease policy. He seems very determined
You're not
that
the
that is
first
the
to
right
say
direction.
it. Steve Rashuda, Mizuho, said exactly the same thing. You're saying the same thing as well. This is a chairman that wants to cut interest rates. So if I'm looking across the curve right now, listening to everything you've said, I can see why maybe you want to buy the front end of treasuries. Big rally, looking for rate cuts. Further down the curve, I'm wondering if they're willing to tolerate higher inflation, just how things are going to develop at the longer end of the curve. What happens there?
I think you see a little bit of what we've seen over the last 24 hours. You do see the curve steepen up a bit. You do see the front end. Maybe it's the 5-year part of the curve. Maybe it's the intermediate bonds that do really well. I think that's what happens. We've obviously still got an inverted yield curve. We know that typically isn't normal, and we should reverse that at some point. So for me, I don't think you're necessarily going to see a big sell-off in the back end. Given, I do think there's huge demand for bonds, and I think bonds look attractive in real terms. But it's that front end that obviously can do a lot of heavy lifting. But again, this is more of, in my mind, a carry environment, because I don't think we're going to go back to where we were at the very beginning of the year. I don't think we're going to see 7 cuts unless we start to see deterioration in data. And when you look at the dots, obviously the median stayed the same, but the mean just moves a little bit higher. So there are the Uber doves out there who were calling for 4 or more cuts this year. They seem to be taking a cue from the data and sort of coalescing around the central of 3 cuts.
To John's point earlier, how much is this part of the bid behind gold? The idea that is sort of more of a safe haven at this point than longer-term bonds when you're not sure about what's going to bring inflation back down to 2%. And people are looking for some sort of ballast at a time where inflation is still a risk.
Yeah, I think there's a few reasons why gold's doing well. Obviously, that is part of it. People are concerned that actually inflation isn't coming down. You want to have that. I think there's people that are saying, well, actually monetary policy is going to be easing. You want to go into real assets. What I don't think it's showing you is that people are particularly concerned around economies. Often gold has been seen as that safe haven asset. But when you look at as you pointed out, you look at the rest of the financial conditions, you look at stock markets, you look at credit spreads, gold's not, I don't think gold's really showing you that. I think it's more the inflation and maybe more the real asset argument.
The Bank of England decision at about an hour or so. I'm not sure what signal I should take from the fact that you're here and not there. Is that something I should pay attention to in 60 minutes?
I think what the most interesting thing for me will be the dissenters.
Yeah.
And whether we get some of those dissenters moved back down. If we get both dissenters saying we should stay on hold, I actually would say the market will take that as a dovish signal. We get the expectations of wage data at the same time. Is that coming down? The movement in the UK has obviously been quite supportive this year. Maybe different to what we're seeing over here, and it'll be interesting to see how the Bank of England are reading that.
I'm going to do it, Tom. I appreciate the dissent. That's what TK would say, and I agree with TK when he talks about this. I appreciate the dissent at the Bank of England.
I appreciate that Ian Steely had a very constructive way of answering the fact that you said, what signal should we take that you're here and not there? But I'll let that
Second tier central bank.
That's what
Some
you said.
people have said.
I'm not going to say that. I'm going to defend the Bank of England.
Ian, this was great. It's good to see you. Thank you,
very
sir.
much.
Ian Steely of JP Morgan Asset Management. Coming up next on this program, on the second hour of Bloomberg Surveillance, Richard Bernstein of Richard Bernstein Advisors, Jennifer Flidden of Invesco, Sebastian Page of T. Rowe Price, and Callum Pickering of Berenberg. All of that still to come, live from New York City. Equities, all-time highs and some. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. How does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Policy rate is likely at its peak for this tightening cycle. It will likely be appropriate to begin dialing back policy restraint at some point this year.
I think this is a signal, and the market is taking it as that they will tolerate slightly higher inflation for longer.
So yes, they have to tolerate a little higher inflation in the near term, but I don't think they're giving up on that 2% goal.
I think this is a Fed that really wants that soft landing to continue.
So we still think we're going to cut rates this year. Timing's uncertain, and he said over and over again, it depends on the data.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The signal this market took was buy stocks, heck, buy everything, buy bonds, buy gold. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. The second hour begins right now. Your equity market on the S&P 500 positive by 1/3%. We've heard it a few times on this program in the last few weeks. We heard it again in the last 10 minutes. Ian Steely, JP Morgan. This chairman wants to cut rates.
Even if the data isn't cooperating, and that is the caveat that we learned yesterday, and the reason why people are saying, well, it's off to the races, because if on one hand you're seeing strength, and the other hand you see a Fed that wants to ease monetary conditions, well, what's the holdup?
I always reflect on guest conversations we've had. I want to go all the way back several months. Ben Laidler, eToro. Ben Laidler comes on the program and he goes, Fed puts back. We both start looking at each other like, what's he talking about? The Fed puts back. After what I heard yesterday, the Fed puts back. He said it repeatedly. And he talked about it in January too. We're not scared of stronger growth. That's implicit, basically explicit in both the forecast and the news conference yesterday. And I think they are basically telling you if growth weakens, we're ready to go. We'll cut interest rates, regardless of whether inflation is, because we're revising that higher.
I want to just issue a mea culpa to Ben Laidler, because when he said that, I immediately turned to you and said, what is he smoking? There is no way. This is a totally different regime. Inflation is front and focus. Ben Laidler, you were correct, and I was vastly wrong, and this is sort of where we are. And to me, this has been the big surprise, and that everyone was expecting that all that pain that we heard from Fed Chair Jay Powell was going to come into the market. It never has. And oh yeah, they're done. They've achieved their outlook.
That Volcker impression back in August 2022 in Jackson Hole, that 8-minute address, there's going to be pain. What pain? Here we are a few years later. I remember a number of years ago where the chairman would say the objective was to extend the cycle. That's what I heard yesterday, even though he didn't actually say it. I think that's what he's communicating. The objective here is to extend the cycle. He doesn't want a recession. He doesn't want one.
You touched on this point earlier, and I keep going back to Rick Reeder's note of BlackRock, where he was talking about how a lot of the inflationary pressures are not in the control of this Fed. The Fed is concerned about sentiment and concerned about things getting out of their control at a time where, when you take a look at service inflation, insurance, medical costs, education, none of this stems from an interest rate policy. It raises this question, well, then what's going to control those things? Is it really just supply side kinds of responses? And is the Fed basically saying, we're done because all those things are out of our control?
The concerns from holding too long seem to be greater than cutting too soon, based on the communication we got in that news conference yesterday. And I think this market hears it loud and clear. Green light in the news conference by stocks. That's exactly what happened yesterday. It's what's happening this morning. We're positive by a third of 1% on the S&P 500. We're calling it the everything rally. It's not just stocks. It's bonds too. We're down 4 basis points on a 10-year, 422.94. On a 2-year, down 4 basis points, 456. So Monday, north of 470. At the front end of the curve. Lisa, here we are on Thursday, south of 460. Big turnaround.
And the consensus right now, 70% chance of a Fed rate cut in June, because the data will not cooperate enough for them to go ahead. That's basically the consensus right now in markets.
Coming up through the next 60 minutes, we'll try and challenge that consensus with Richard Bernstein of Richard Bernstein Advisors on why he thinks the Fed may go the whole year without cutting. Jennifer Flitton of Invesco as Biden doubles down on America First, and Callum Pickering of Berenberg ahead of the Bank of England rate decision in about an hour's time. We begin with our top story. Stocks posting fresh all-time highs as Chair Powell stays the course, boosting bets the Fed will begin cutting rates in June. Richard Bernstein of Richard Bernstein Advisors not expecting any reductions this year, even suggesting there's a chance of a hike. Richard, I'm pleased to say, is with us around the table. Richard, good morning to you.
Good morning, John.
Let's start with that press conference. What did you make of that just yesterday?
I have the unfortunate view of kind of viewing him as a bartender still pouring drinks. I think we haven't heard last call yet, and as you said, that's causing speculative assets to go up, and that's the natural reaction that should go on when the Fed is going to provide a lot of liquidity in an already liquid environment.
So what's the answer? Keep drinking.
Keep drinking. I suppose. I guess my confusion is that there's, as you said, everything's going up. It seems to me that we should be seeing the cyclical sort of pro-inflation side doing much better, and I'm not sure that's actually happening. And so I think there's still very much a speculative fervor within the market, whether it's the Magnificent Seven, whether it's cryptocurrencies, anything like that. I think that's kind of the warning sign out there. But the more economically sensitive stuff should be doing well.
Well, you point to some of the more speculative stuff, and then you say Magnificent Seven, Fabulous Five, if you want to take out Apple and Tesla. I am curious, though, about why that is speculative if the earnings are there. And that's basically the justification that everyone who comes on the show gives.
Right. I think it's not that they're bad companies, right? There's always this notion that we have to worry that somehow these are bad companies. They're not bad companies. The question is, are they unique companies? And I don't think they are. Right. In the latest reporting period, we have, just for the S&P 500, 150 companies growing earnings 25% or more. Right. So only 3 of the Magnificent Seven passed that screen. So there's clearly a lot of choice out there. Why would anybody focus on the Magnificent Seven? And history says that when profit cycles trough and you start getting this broadening of the earnings base, that the market starts broadening. And that's kind of happening in fits and starts, but just not happening.
The theory that we hear from a lot of strategists is that if the Fed were to cut rates, that would actually allow the broadening out. It would allow some of the other 495 stocks to really gain some momentum, just because those are the most affected by high interest rates. Why do you disagree?
I don't disagree with that. I think where my confusion is more that why would the Fed want to spur a speculative aspect to the stock market and to the financial markets, period, right? Like cryptocurrencies, because ultimately bubbles, or very speculative periods, if you don't like the word bubble, bubbles are inherently inflationary.
Lisa loves the word bubble. Don't worry about that.
Okay, go for it.
Okay, and they're inherently inflationary because you misallocate capital within the economy, right? You allocate capital to things you don't need, and you don't allocate capital to things you do need. So ultimately, you spur inflation, and I don't think the Fed has thought that one through.
Where are the signs of euphoria right now? How do you identify that in stocks at the moment?
I think if you look at just stocks for a second,
sure.
If you look at the Magnificent Seven effect in an environment where 150 companies are growing earnings 25% or more, that I would argue that's euphoria. That was the tech bubble, by the way, in 1999-2000. The profit cycle was accelerating in the United States, but nobody cared. Everybody just wanted tech. Today, the profit cycle is accelerating. Nobody cares. They want 7 stocks. So I was in the stock market. I would say that's the place where you see it the most.
When you talk about how they're fueling a bubble or some kind of speculative fervor, there is a question of whether their policy matters at all with respect to inflation, right? This idea that what's spurring the speculative bubble is not Fed policy at all. It's something else, maybe fiscal, and that the Fed is trying to respond to what they can control, commercial real estate, some of these other aspects, which have felt the bite of it.
Yeah, I think the key word in what you said there that I think is most important is the word respond. That a lot of investors believe that the Fed is somehow a leading indicator. The Fed is a lagging indicator, always has been. Maybe maybe not the Volcker Fed, but every Fed has been a lagging indicator. You think about what they look at. They look at inflation and unemployment, 2 lagging indicators, and they respond to lagging indicators. So that's the thing that I think presents the opportunity right now is that you've got leading indicators that are starting to get stronger. You saw building permits the other day, a leading indicator of the economy getting stronger, but the Fed is still reacting to the lagging indicators. I think that presents a tremendous investment opportunity because it says that we're likely to have more growth rather than less. When the leading indicators are heating up and the Fed is going to ease, that to me says you're going to see more growth rather than less, and that calls for cyclicals.
This isn't just a tactical call from you. We've been talking for a while about this. This is a long-term call, a change of regime, if you will. Can you just explain that a little bit more?
I think on top of what we're seeing with monetary policy and everything else, you've got the secular backdrop of globalization contracting. And I think that is the long-term story. I know all the excitement about AI and everything else. I think contracting globalization is the real story because the United States is now in the unfortunate position of having a massive trade deficit as globalization contracts. That is a really bad combination. And it means that the United States is going to have to rebuild our own capital stock. You know, people call this reshoring, nearshoring, friendshoring, infrastructure. You know, there's so many words for this, but it's all the same theme that we have to rebuild the United States capital stock. I think that is the most important story out there right now.
So what do you think is going to work this time in this cycle that didn't work last time in a previous decade, pre-pandemic?
I think small cap stocks, in particular, the area that I think that people aren't paying any attention to, which I don't understand at all, is small and mid-cap industrial stocks. Small and mid-cap industrial stocks have outperformed the S&P 500 over the last decade, even though small caps have not. Small and mid-cap industrials have, which I think is the beginning sign of this kind of deglobalization, rebuilding the American capital stock.
Do you push back against people who say that bigger companies are better equipped to actually handle some of the volatility that we're seeing in inflation and just the global backdrop?
I find the love of large companies very interesting. When I started my career, which was too long ago to talk about, now I hate talking about because it just says I'm old, but when I started, senior analysts followed small companies because in the late 70s, early 80s, it was a massive small cap rally. And small caps were considered sexy. And so senior analysts followed small cap companies. And the big companies that were boring were followed by junior analysts because there was no excitement there. And as you go through the 80s and into the 90s and the investment banking cycle starts picking up, you find that starts switching. And so now you have everybody loving large caps, saying small caps are no place to be. And I think we've gone 180 degrees. I think it's an amazing thing to see when I think the opportunities are so. The way I describe to people is, are there really only 7 growth stories in the entire world? Are there only 7 growth stories in the entire U.S. economy? Of course not. There has to be a lot more. That's where the opportunity is.
What if there's only 7 growth stories people care about? It doesn't matter how much you talk about it. It doesn't change things. Well, money's gone passive, the way we invest has changed, and the winners just keep on winning. How do you change that?
So, John, that's kind of the argument that people say, will value investing ever come back, right? And my point is that everything in life is centered around value. Everything we do is centered on value. If I tried to sell you a Volkswagen for a Bentley price, you would not buy it. Right? We all understand value, but for some reason, there's periods in the stock market where people say it doesn't matter. I think this presents a tremendous opportunity for value, given that nobody cares about it anymore.
You're going to be sticking with us. We'll continue this conversation. Richard Bernstein there of RB Advisors. Looking at stocks at the moment, equity futures positive by 1/3 of 1%. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Bank of England is expected to keep rates on hold, giving more time for inflationary pressures to cool before cutting rates. Governor Andrew Bailey opened the door for cuts this year at the last meeting, but maintained a vague timeline, with investors betting the first cut will arrive in August. The decision is due at 8 a.m. Eastern. New Zealand's economy unexpectedly contracted in the final quarter of 2023, pushing the country into recession. Economists had been expecting growth of 0.1%, but instead, GDP fell for the second straight quarter. High interest rates have dampened consumer spending and investment, with the Reserve Bank keeping rates on hold since May, and last month signaling it doesn't intend to lower rates until 2025 amid record immigration and stubborn inflation. Korean Airlines signing a $14 billion deal with Airbus to buy 33 wide-body jets as it looks to streamline its fleet ahead of a merger with Asiana Airlines, South Korea's biggest carrier, preferring the Airbus model to that of rival Boeing, which had typically been the carrier's top aircraft supplier. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, Biden doubling down on America First.
I want to build a future in America. My predecessor could let the future be built in China and other countries, not America.
That conversation up next, live from New York this morning. Good morning.
Was going to keep Rain World Cup. This is a 3 as the economic picture, covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Stocks on the S&P rallying once again this morning. Good morning to you all and welcome to the show. Equity futures up by 0.4% on the S&P. Under surveillance this morning, Biden doubling down on America First.
We will enable advanced semiconductor manufacturing to make a comeback here in America after 40 years. Unlike my predecessor, I was determined to turn things around, to invest in America, and all Americans. And that's what we've been doing. I want to build a future in America. My predecessor could let the future be built in China and other countries, not America.
It's the latest this morning. President Biden visiting an Intel campus in the swing state of Arizona after awarding the chipmaker $20 billion in investments to build out the nation's domestic semiconductor production. Jennifer Flitton, head of U.S. Government Affairs at Invesco, joins us now for more. Jennifer, I was listening to those comments and I was reading the transcript and I just thought, if you changed President Biden and put in President Trump, don't they just sound like each other? Isn't that the same language?
Yeah, we have sort of come full circle. I think this was a very bipartisan bill, right? The CHIPS Act that was passed in August of 2022. And we saw a lot of support on both sides for this movement to bring advanced manufacturing of semiconductors back to the United States. And this wasn't just spurred from a need for global competition, but also we saw the chip shortage from the pandemic. And that was very real, right? Because we have chips in everything from refrigerators to cars. And we saw the constituents of these senators and these congressmen across the nation being affected by that. So that's a reason why, that's the main reason why this was such a bipartisan initiative.
The president was in Arizona at that campus of Intel's. I just wonder how quickly we'll start to see results from these kind of handouts for state money, federal money to companies like Intel. How quickly do you see the benefits from that?
Well, we've already seen some money being given to Intel. They've already announced, even prior, I think, to the CHIPS bill being passed, that they would be creating a facility in Ohio, another important state this election year. But we will be seeing even more grants and loans coming out of the Commerce Department in the next several weeks. So I think this will have an impact in the minds of those communities who are going to be affected and are going to start to see some of those jobs come in. But this takes a long time to create. These manufacturing facilities could take a year, 2 years, and not only that, but you need that workforce. And there's also money in this bill, grants to develop some of that workforce and that education where these facilities are going to be located. What's the time frame for this bill and the money in it being doled out? And I ask this because people talk about fiscal stimulus running out. Well, is it, or is it kind of ongoing for the next few years? Right. There was $50 billion included in this bill, and that's going to take a long time to get out. And we even saw, this is a little late. I mean, we passed it in August 2022, and we're now really starting to get that money out the door. And it is going to take even longer for these facilities to be built and start running. But it was already in the hearings leading up to the markup of the bill out of both houses, it was already sort of being told that this would probably be an 8 to 10 year project. Which raises the question, Jennifer, of what's behind it, right? I mean, we already heard from Pat Gelsinger that he needs more in order to truly compete with some of the semiconductor giants in the world. Is there room to have additional spending on this front, given some of the concerns about deficit, given some of the increases that we've seen in benchmark rates? Well, I mean, this money has already been allocated. I think the question really will be the next allocation, right? I mean, the Commerce Secretary Raimondo has already sort of signaled that, telegraphing to Congress, will likely need more investment here. But it's not so much the money, it is the dedication from the U.S. government to these companies to show them that we are with you, we are supportive of you, because it's going to take some regulatory initiatives to also ease some of the environmental issues to even build these facilities. There's a lot that goes into this behind the scenes, some of the red tape, and it's important to show that sign of solidarity.
Jennifer, just a final question from me. The policy looks similar. The language sounds the same. Yeah. Who's connecting with voters best? Whose message is more effective, even though those messages are quite similar?
Right. I think there's a populism streak running through American politics right now, and both sides are really trying to latch on to it. I think that as it relates to infrastructure, right, you had the previous administration talking about infrastructure through his entire first term. It finally got done in the Biden administration first term. But those were talks in Congress that were happening for a very long time. I mean, every week it felt like it was infrastructure week. So some of these issues are just by nature bipartisan. And I think we're going to see that sort of push-pull and some of that populism sort of streak running through this election this year.
I think that's actually because it was basically every week was infrastructure week. Do you remember that?
I do remember
that. Found that way because it was.
Yeah, well, we were not exactly. We mentioned that frequently.
Jennifer, thank you. Jennifer Flitten there. of Invesco. That language, Lisa. I want to build a future in America. My predecessor is going to let the future be built in China and other countries. That could be in a Trump speech. Biden's trying to out-Trump Trump himself going into November.
Which is the reason why the big takeaway for a lot of people is look at what both of them are going to do, which is keep the spigots on. And that, to me, is a huge takeaway at a time where this money is having, real impact in specific states and also for companies.
We've got Richard Bernstein with us. Here's a quote from you, Richard. I want to share it with our audience. Politicians, CEOs, investors understand the US's national security risk of being dependent on the rest of the world for semiconductors, but they don't seem to understand the US's national security risk of being dependent on the rest of the world for virtually everything. How big a change are you expected to see?
John, this is not a change that's going to occur before the next commercial break. I can tell you that. It's going to be something that's really a 5, 10, 15, 20-year story. That exactly what you've all been talking about here is kind of the rebuilding of the American capital stock, that we have become dependent on the rest of the world. That was globalization. And that's fine. As long as globalization was expanding, it didn't matter that we had a trade deficit. Now globalization's contracting. It sets up the United States in a very precarious position, the U.S. economy in a very precarious position, if not the overall country. And I think, we have to come to the realization that we are last among major economies in infrastructure spending still. Despite everything we're talking about, we're last among major economies in infrastructure spending. We are last among major economies in shipbuilding capacity and things like that. These are real issues as globalization contracts, and whether it's Trump or Biden, to me, I think either way, that theme of rebuilding the American capital stock is going to be the central theme of investing for the next 5, 10, 15, 20 years.
Which area looks most rife for opportunity for you as an investor based on that, given the fact that we've seen some stops and starts, right? We talk about electric vehicles. We've talked about the idea that central planning doesn't always work that well.
Right. So, Lisa, let me here's the way I would think about it. I think everybody knows that California has that proposition or law, whatever it is, that by 2030, 2035, all vehicles sold in the state of California have to be electric vehicles. Okay, we could argue, is that good or bad public policy? But the reality is the California electric grid can't support that. Right? So is it a better investment theme to go and invest in electric vehicle companies, or is it a better investment theme to invest in the industrial companies that are going to build out California's electric grid? At our firm, we're betting on the industrial companies that are going to build out the electric grid, because it's the infrastructure that you need to even think about electric vehicles. If you don't have that infrastructure, who cares about electric vehicles?
Someone's got to pay for that. Who's going to pay for that? I'm thinking about the fixed income side of things now. Right. Who's going to pay for that?
That's an interesting question, because now you get into the whole point about we are so debt laden. How do you pay for all of this? I think the necessary evil, and this will of course get people riled up, you're going to have to raise taxes. You're going to have to. You're going to have to raise taxes. You're going to have to redirect spending. It's going to be a whole different story for both parties, right? I think the Democrats are going to have to give up on the notion of let's spend for the 2-year election cycle. I think the Republicans are going to have to give up on the Laffer curve in an open economy, because the Laffer curve has proved not to work in an open economy. Our tax cuts have stimulated other countries, not the domestic United States. Is like, well, think of Apple. Where does Apple gets corporate tax cuts and they build plants in China? That type of thing. I think you're going to have to see a complete reorientation of both parties' economic policies.
It's a lot of work, Richard.
That's what I'm saying. It's 20 years.
And I've only got 60 seconds left. Yeah. Richard Bernstein of Richard Bernstein Advisors. Plenty of work, Bramo. How quickly are we going to see those political changes? How quickly is that going to happen?
Well, that's what I'm thinking. Maybe that's what you need to have happen to balance the budget. Will you actually get that to happen, given that every election cycle it's sort of a race to the bottom in terms of who can cut taxes and give out, more incentives to people that their lives are going to be better?
Richard, this was great. Got to do it again soon.
Yeah,
thank you, buddy. Equities right now up a third of 1% on the S&P 500. Coming up next, Sebastian Page of T. Rowe Price on the Momo, the FOMO, and the YOLO. That is not my quote. That is his. He owns it. We're going to be talking about it next.
about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Policymakers and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Things are so euphoric this morning. Our next guest, Sebastian Page, believes he can get me to go on the Icon of the Seas, the cruise.
I think you will
Seriously.
be able to. Yeah. There's a gym.
Seriously.
There's lots to do.
That's when you know there's been way too much happy talk if I ever agree to that.
Well, hold on a second. Are you thinking about it?
Absolutely
Hold on
not.
a second.
Not
Headline.
even, not even
Jonathan
for a
Farrow
second.
is actually going to go on the Icon of the Seas.
Not even for a second would
But
I
I think that you
consider
just said that you were considering it.
Absolutely not. No.
I think you said the words considering
I cannot
it.
even come up with a number that would make me want to go on that ship for a week.
We'll work on that one. We'll try to come up with some numbers for
They
you.
can work on that one. Let's figure it out. Have to be very, very big. Equities right now on the S&P, positive by 1/3%, up by 0.8%. I don't take bribes, just in case you're wondering. In the bond market, 2-year, 10-year, 30-year, you know, people are going to clip that, you know.
Yeah, exactly.
He's willing to take money to go and,
It just,
you know.
they're going to cut off the first part.
I'll say
taking
this,
bribes.
if I ever speak favorably about cruises, you know someone's paid me.
Actually, that means that you've had artificial intelligence replace Jonathan Farrow.
Possibly, the robot's here. Down 3 basis points on a 2-year, 456.82. The everything rally continues, down 4 basis points on a 10-year, 423. Want to turn to foreign exchange briefly. Surprise rate cut, if you're just waking up stateside, from the Swiss National Bank, down 25 basis points against consensus, basically fueling a weaker Swiss franc. Dollar Swiss breaking out by 0.7%, Lisa. That's the first one. Bank of England in about 30 minutes.
I like that you say first one, because yes, this is the first rate cut among some of the, well, what do you call this, the central bank?
Tier 2 central banks.
Tier 2 central banks.
Yeah.
Either way, there's sort of a race to cut at this point, and I think that you do get this sense that it is beneficial to be on the front end of that, at least for the Swiss National Bank, that's concerned about currency that was too strong for them.
I call them 2-tier central banks or tier 2 central banks, but you can still make a very good living. Have you seen what the S&P president earns? Swiss National Bank president, upwards of $1 million Swiss.
Seriously?
Which compared to what you can earn at the Federal Reserve as a governor, I think the governors get a couple of $100K as a governor. And I know, granted, you can go and earn lots of money in the private sector after doing that service. I always remember, I've talked about this a few times, so if you've heard this story before, forgive me. But the ECB, different pay structure there as well. You can get more as the national central bank governor of Italy compared to being the ECB president or serving on the executive board. The pay there is all very, very weird.
You spend a lot of time thinking about the pay. Are you thinking of that too?
To go and serve
serve in the central bank. You try to figure out which
put
central
myself
bank
in the running
would
for
be
that.
the best to
What am I doing here in the last couple of minutes? Going on a cruise, getting paid for a review.
100%.
880 Swiss francs, whatever it is.
Yeah.
1,000. Yeah,
you're going to run the Swiss National Bank and go on a cruise.
I don't think anyone wants me running the S&P. Under surveillance this morning, I don't think they want me running anything. Chairman Powell sticking to script. The Fed keeping rates on hold for a 5th straight meeting, staring down a string of hotter than expected inflation prints to maintain their forecast of 3 rate cuts in 2024.
We believe that our policy rate is likely at its peak for this tightening cycle. The economy is performing well, and the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down.
It's that line there, Lisa, that keeps jumping out. Inflation came up as a separate matter, distinct, almost divorced from growth being better than expected. And it's that message we keep hearing from this Fed chairman, who's essentially saying repeatedly, strong growth is not a problem for us. We're okay with that.
Which really speaks to this point that we've been talking about all this morning, which is the inflation that we're seeing even under the purview of the Federal Reserve? Do interest rates even matter for some of the inflationary pressures? And if so, what's their compass for moving away from restrictive rates if it had no effect on bringing inflation down and at this point, isn't necessarily facing off with an economy that's struggling for growth?
So no moves from the Federal Reserve. We've had a move from the S&P, also had a move earlier this week from the BOJ. First interest rate hike in something like 17 years, done in part to avoid the need for aggressive action later. Speaking in Japan's parliament, Governor Ueda warning that waiting to hike would have greatly raised upside inflation risks, saying, quote, the possibility would have strengthened for very rapid and large rate hikes after the end of large-scale monetary easing. We made our decision after weighing those risks. What do you make of that, Bramo? Just some clarity as to why they went this time, right now.
Operation try to strengthen the yen a little bit. That's what I view that as. Basically coming out and saying, stop thinking this is the most dovish thing and ever. We want to keep you guessing about whether we're going to hike rates again. And to me, that's how I viewed it, because there was other kind of rhetoric out of, the ether, some unknown sources talking to people about potential rate hikes, further rate hikes from the Bank of Japan. I mean, this is what we expected when we saw the yen weaken to such a great degree.
So that was the objective. If that was the objective, can we sort of judge how successful they've been in the last few days? The last week, for that matter? Would you say that was I know early days, but would you say that is a success?
I would say that the success for them was that Jay Powell was dovish. And that basically gave them a complete out to be able to continue with a very muddied but otherwise dovish message and not see a massive devaluation, more than already what we've seen with respect to the Japanese yen.
Well framed, because the dollar going into that news conference was strong, strong, strong versus G10. G10 just flipped by the end of the day. Let's talk about a single name, Apple, slightly lower this morning, with the Justice Department poised to announce a lawsuit against the tech giant, accusing it of violating antitrust laws by blocking rivals from accessing certain features of its iPhone. It's the latest in a raft of suits against tech companies, with the DOJ already suing Google and the FTC pursuing cases against Meta and Amazon. I just want to talk about Apple. Let's throw up year to date, just where Apple is right now in 2024. Apple, never mind the Mag 7. We talked about the Mag 1, the Fabulous 1, whatever, NVIDIA. Apple is down by 7% year to date, and it's not just this. It's almost nothing to do with this. Where's the growth going to come from in 24? How quickly can they adopt the AI features for the new iPhone this year to really fuel that upgrade cycle?
Well said. This antitrust suit's been going on since 2019. The larger point for Apple is, on every side, they're getting challenged. And right now, what we saw from the recent innovation with respect to partnering with Gemini, with Google, is that they are up against Samsung coming out with a smartphone that uses artificial intelligence come September, and they need to get ahead of that after the failed venture into the car. This, to me, is going to be a fascinating development for one of the world's biggest companies that was one of the drivers of the strength in the equity market for so many years.
Apple just a little bit softer. We're down about 1% in the pre-market. I need to take a deep breath for this. A quote from our next guest, Sebastian Page at T. Rowe Price. Do you have FOMO on Momo because YOLO? What are you doing to me, Seb? The conclusion, don't fear the Momo. I'm not telling you to load up on risk assets with a concentrated position in large cap tech, but I would not hit the panic button. A fully invested and balanced approach with disciplined rebalancing from growth towards value, leading to a tilt towards value, seems warranted. Sebastian, what was that? What was that? Do you want to explain that?
I wrote that just for you, Jonathan.
Thank you, sir.
Because I know you like acronyms. I also, in my update, revealed that I spent last week on a cruise with my family.
We're going to talk about the icon of the seas in just a moment. Last time we spoke, you said you were enthusiastically neutral. Is that still your approach to markets right now?
We're still neutral. The momentum situation is really interesting. We just concluded a study of momentum. And if you naively buy the top performing stocks every month, and you look at the performance of that kind of strategy, it's at an all-time high. So momentum, based on the data I have, which goes back to the 90s, but I've also looked at data going back further, momentum's never worked this well in markets. And this is kind of worrisome. But the conclusion of our analysis is that when momentum spikes like that, it's not necessarily a bad thing for markets for the next 12 months. That's counterintuitive, but that's what we're finding.
So stick with winners is the essential message here, right?
Yes and no. It's not a systemic risk. The winners themselves, when momentum is high, can continue to do well. You know, the big bear markets we had, especially the last three, 2022, 2018, and 2008, occurred when momentum was actually really low going into it, the performance of that naive trend following. So I was surprised by that. And if you look at all the times when momentum was in its top quintile and you look 12-month forward, the average return for stocks systemically is 14%. And the average return for the high momentum stocks is also pretty solid. Now, here's the caveat. There's a fat tail, and this is what happened in 2000. In 2000, momentum was super high, and you had the mother of all momentum crashes, right? So you have to manage the risk. That's why you end up neutral.
Do you have a fear of missing out on momentum because you only live once? I'm just really deeply internalizing this message that's pretty profound. This idea of the fat tail. How do you know when you're getting close? And if you're not getting close, why be neutral? Why not just be aggressively overweight and into the Momo because of FOMO and YOLO?
Love that question. So we looked at all these...
It's your own question.
We looked at all the momentum spikes historically and studied them and looked at what happens after. And there's a huge difference on whether the momentum is driven by momentum in underlying fundamentals or whether it's a quote-unquote junk rally. So if you look at the quality factor and see if it behaves similarly to the momentum factor, then you can be reassured. Don't fear the Momo. This is where we are right now. Fundamentals have had really, really good momentum, sustaining price momentum in some of the large caps. So it's not a junk rally situation. The big momentum blow up of 2000, non-earners were spiking, and quality was actually not in favor. That's the warning sign you want to look for. And by the way, going back to the last three bear markets, momentum can actually weaken quite a bit and go to the bottom quintile before a market crash. So warning signs, Lisa, look for when it gets junkier, when fundamentals aren't sustaining it anymore. We're not there yet. And it can actually soften before a market crash, at least historically.
So why wouldn't you say this isn't euphoria? Why wouldn't you say that this isn't a bubble, this isn't speculative, this isn't, you know, excessive Momo and all the other things that you said? But I'm at a certain point, why not say this is the reality? Because it's supported by the fundamentals, which is the case that so many people come on and make.
Yeah, and another way to look at that question is to look at the price-earnings ratio of the high momentum stocks, right? The ones that have done well for the last 12 months, and divide that by the price-earnings ratio of the market. So now you're looking at the relative valuation of the high momentum basket. That's actually, it's elevated, but it's not crazy high. You can draw the chart, and you're miles and miles and miles away from prior bubbles. Again, fundamental, sustaining the momentum. I think we're maybe a mile from the cliff, not a meter or a foot from the cliff. You know, so there's time to see if this is going to unfold into a market broadening, which I think it will, and continue to be sustained by the underlying fundamentals. That's the key question.
That's really the question I wanted to ask you. What would make you enthusiastically bullish, away from just being enthusiastically neutral? You offered three things to focus on coming into this year. It was earnings, consumer, and the blob of money. Where is that now? How are things developing?
The blob of money is still there. Let's start with that one. I watched your show at Bank of America. I thought it was excellent.
Thank you.
And they mentioned, look, they have 37 million consumers, and they look at the checking accounts, and they mentioned 40% higher balances across income quintiles than 2019. So the blob of money is alive and well. Earnings are going up by maybe a double digit or high single digit. And the direction of Fed policy is down. So everything's awesome. Why aren't we not long? Well, yes, valuations are elevated. We've had a massive rally in growth stocks. So what would make us more bullish, Jonathan, because we like to lean against the wind, would be a market pullback. all else being equal, a spike in the VIX. I miss Tom to talk about the VIX. Seeing the VIX at 25, 30, for us would be a moment to get more aggressive, lean into risk assets at cheaper prices.
Just real quick here, does the Fed not matter?
The Fed matters because everyone is obsessed with the Fed. But in terms of inflation, we've had a supply effect that I think has been maybe even more important than the Fed. I think the Fed will also matter if they surprisingly get more hawkish. My view is that there's upside risk to inflation. Our CEO asked me into his office yesterday to talk about my market views. I sent him an email with one chart. I said, I think this is the most important chart in capital markets at the moment. It's a chart of the one-year break-even inflation implied by the markets. It was 2% in January. It's at 4.1% today.
Just real quick, how much of the blob of money is going to go into cruise line tickets that are, floating cities on the ocean for some days?
This is your turn now for the review. You ready?
So here's I'll give you a one-word review. Tolerable.
You tolerate
Screaming
it.
endorsement.
Yes,
Okay.
the family loved it. And we did go on Icon of the Sea. And it's not as crowded as you think, Jonathan.
Because it's so big.
It's so big, and everybody goes to the same place, the pool, and then you have places to go, different restaurants on the ship to hide. You also go on islands, which is kind of fun, right?
Because you get off the boat.
Yeah, I took my son on a 2-hour hike on St. Martin. That was fantastic.
It sounds lovely, the island piece of it. Would you go again?
Not too often.
Okay, I think that's a no. Well, he tolerated it.
Well, it's for the kids. I mean, essentially, that's what it is, right? They go do their thing.
It's like Disneyland.
Exactly, and then you just try
it.
to hide it and feel like you don't have to entertain them too much. I'm just saying, theoretically, if I were in that position.
Oh, you would do the same thing?
Well, I don't know that I would do the same thing, but
Jonathan, the truth is, it's a democracy in my family, and I got outvoted 3-1.
There we go.
To go on Icon of the Sea.
That's it. So fantastic to see you, buddy. It's good to see you, sir. Sebastian Page there of T. Rowe Price. That sounds about right. That didn't look like a man that wants to go on Icon of the Seas again anytime soon. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hekes. Hey, Yahara.
Hi, John. The Swiss National Bank cut its key interest rate by 25 basis points, acting months ahead of the Fed and ECB. Officials lowering their benchmark rate to 1.5%. Some investors were betting on a cut, but most economists predicted the rate would stay unchanged until at least June. The franc tumbling after the decision, falling 1% against the euro to its weakest level since July 2023. Reddit will make its stock market debut today. The social media platform priced its IPO at $34 a share, the top of its expected range. The offering values the company at almost $6.5 billion. Shares will trade under the ticker RDDT on the New York Stock Exchange. Bloomberg Technology will have an interview with Reddit COO Jen Wong live at 11:45 Eastern. Micron Technology is surging in the pre-market after it gave a surprisingly strong revenue forecast for the current quarter. The strong outlook underscoring soaring demand for the hardware used to power artificial intelligence. The largest maker of computer memory chips in the U.S. says fiscal third quarter revenue will be up to $6.8 billion, topping the $6 billion expected by analysts. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, the Fed's done. The BOE is on deck.
A plan to bring inflation down. That plan is working, but we do need to stick to it and see it right the way through. As inflation gets closer to its target, that opens the door for the Bank of England to consider bringing down interest rates.
That conversation up next, that decision, 15 minutes away.